Very good morning to you. Welcome to Trade Live with IG with myself, Rich McDonald, and Claude Beecham. How are we doing?
I'm very well, thank you. How are you?
Very good.
Why am I Claude? Why am I Claude this morning?
No, I'm
a source of all knowledge. Is that what it is?
The source of all knowledge. There is nothing artificial about your intelligence.
No, not at all. No. Not much intelligence about it either. So.
We haven't even had a chance to say good morning to each other. So good morning, Chris.
Good morning. How are you?
I just had to run in the studio. I was giving Minnie Cooper an order in Lloyd's for the opening auction, and yeah, we had to. I have to phone it in and everything now.
Of course you do.
Sure. I mean, if I say it on TV, then there's a record of it, right?
There, exactly. Yes. Manipulating the price.
Good. So let's have a look at what's coming up on today's show. We got myself and Claude through till 8:35. At what point we've got the wonderful Garth McKenzie coming in, one of the top traders that we speak to, of course, because he has interviewed all the other traders and gathered their knowledge as well.
That's very good. Yeah.
So yeah, Garth, looking forward to having Garth back on the show and his market view as well. And then, well, I think you should be taking us through the second page there.
Well, 9 o'clock, it's back to you again for the opening bell, and then me from 9:10 for about 25 minutes. We'll be doing Trade of the Week. What was last week's? Oil was last week, wasn't it? That was good. Let's see if we can get another...
Short oil?
No, long oil. We were long oil last week. And then, of course, it slumped, didn't it? So we'll see where we ended up anyway. And then 9:35, Aaron and Martin will be talking through Man versus Machine. What's this one?
Oh, have you not seen Man versus Machine?
No, I haven't.
Oh, it's great. We'll go through that in a little bit. Right, good morning to you all. Catching up with the chat here. Good morning, Boise. Nice little chat on Friday afternoon with Boise. Was right up until 1:29 p.m.
Yeah.
And then, of course, the world unleashed this beautiful thing. A beautiful big unemployment number.
Fake numbers, clearly.
Fake numbers, indeed. Mango, a very good morning to you. Always good to see you on, sir. And Andrew McKelvey is telling us that Senior is pleased with its interims. Is that...
Yes, that was one of the... There wasn't exactly that many numbers this morning, but Senior was one of them. Strong set of results in the first half. So compared to last week, where everyone was reporting numbers all week, it's calmed down a little bit still, although, of course, we do have Palantir today, don't we?
Oh, we'll get onto that, don't you worry. Wiz, pleased with its growth in traffic, says Andrew. And SWC have raised their relatively further sum. I guess a relatively small. I'll have a look at that in a minute as well. I haven't noticed that, Andrew. Thank you very much. And BP announced their biggest discovery in 25 years. Andrew, we need to get you on the show. You should be on the payroll.
Yeah, exactly. We're across the RNSs this morning.
Right, that and other things to come in overnight action. So let's start with, actually, shall we do the week ahead at 8:15?
You're in charge. We'll do as you are told.
Let's do that, because that's
There's enough going on already.
Your wonderful piece that you like to put out on a Sunday afternoon.
It goes out Sunday afternoon, 6 p.m, yes. Although it always gets written on a Friday. Fun Friday to write it, surely. Good old day.
Doesn't Claude work on Saturdays? Let's have a look at the futures and see what happened there on Friday. That's right. It starts with a 6 and a 2. It's not a 6 and a 4 anymore. Small bounce in the S&P 500 after that Friday job roll number. So let's we'll have a look at that in a moment. But oh my goodness me, what a drop we saw. FTSE 100, absolute bulletproof. 9,090 to immune to any sell-off there. But not in Germany. Germany got a right kick.
Yeah, very heavy losses, even bigger as noticed than for the Nasdaq, really. So we saw the DAX go 1,000 points. Both the DAX and the Nasdaq had about 1,000 points wiped off them in the space of 2 sessions. So not a bad move to the downside if you're looking for this kind of thing. It's just maybe a shame it arrived so quickly. I suppose maybe it didn't.
Quickly? We had to wait weeks for this. Weeks, I tell you.
Weeks, and then 2 back-to-back heavy losses days come at once. They're like buses, really.
Yeah. Gold, really good surge higher in gold. That was the obvious trade of all of them, I would say. And then iron ore higher this morning. And copper continuing. And it was nice to see copper get a small bounce while oil sold off. Because, of course, recession concerns, growth slowdown, unemployment higher. That was another relatively obvious one. Gold, oil sitting up there at 60.
Yeah, because it rallied on a sort of hopes that, or worries that there'd be more sanctions on the Russians. So the fact that it then came back again so quickly was quite interesting, I think, really. But it's so much going on last week and so much to sort of digest from Thursday and Friday that it's very hard to keep up at the moment, isn't it? You had Microsoft topping $4 trillion in valuation, you had all the tech earnings, and then suddenly it's will they, won't they on September, because you've gone from Wednesday evening, Fed nothing doing everybody, to Friday, markets pricing in again, much bigger chance of a September cut.
That's right. So Powell set us up for the beginning of the sell-off. Yeah. Let's have a look at the 3-day chart there. And so this has gone back to Wednesday. That was the little move down on the Fed. And then we saw, of course, because we had those Microsoft numbers, and then we started to get the whole travel and arrive move. And then only this is the jobs number here. So why are we talking so much about jobs? Well, let's look at how they were. Now, I have to go to the week before. Previous week. And taking us through. What was the weakness from Chris Beecham?
Oh, now you're talking. Now you're going to put me on the spot. What did we get? Well, the main problem was that it was a very poor jobs number overall, but obviously the revisions, and this is the thing we'll come to a minute with the
that was what I was going for.
So the average hourly, obviously the 14K, a very weak number really, still positive. Unemployment rate up again. But the fact that the previous month has been revised down, was it net 258,000 jobs were wiped off that had existed but didn't in fact
from previous 3 months.
Previous 3 months meant that obviously this was taken as a very, very poor jobs report.
I think she deserves to be sacked.
Well, I think, and there was
you're overrepresenting.
I don't think you're overrepresenting. I think the way that, and this following one of the former White House chief economist guys was saying, he worked with her for years. And I think it's the way the survey is done, because obviously the Bureau of Labour Statistics is simply dependent on companies sending this stuff in on time. Yeah. And if they're pushed for time, they don't get it sent in time, then it gets put into next month's number. So that's why you get the revisions. And so it is not some sort of conspiracy to make things look bad and then look worse.
But it is partially her fault that rates haven't been cut. Because had this data been correct and collated correctly, as you'll see on screen now.
It was collated correctly. It's just it doesn't arrive in time, so you can't make it. I think it's unfair to say she hasn't done it correctly. I think
that's maybe part of your job, isn't it?
But if the Bureau is being underfunded, if there's not enough money going around to sort of provide the people to do this,
then sack the boss and spread that money out.
Well, you could do that, or you could. You seem to be a hard pick. I think we know which side you're on here, but you can either have a cheap Bureau of Labour Statistics that doesn't get it all done on time, or you can have one that's properly funded. So which would it rather be? But it is particularly funny that, as the FT said this morning, you are damned if you do and damned if you don't, because Powell spent Wednesday saying how strong everything was and how good things were going and got slated for not cutting rates. Mm-hmm. And then the jobs numbers come in and look awful. And then he gets slated again for not cutting rates because, suddenly making the economy look bad was obviously one thing he'd said, but also that they weren't moving quick enough. So which is it?
What would the market rather? Would it rather have a strong jobs market, strong economy and good earnings? Or would it rather have the truth that we knew was the case, a slowing economy and the risk of earnings forecast coming?
Well, clearly the market would rather have good news. It would mean that a Fed rate cut is likely. But if it's rate cut or earnings growth and jobs growth, clearly you'd want that. Yeah. And that's the thing that will drive the market more sustainably in the long term, because the worry, of course, is if they do have to start cutting fast because things are getting worse, that should require a re-rating in stocks, particularly at these levels.
So let's have a look at the September expectations. So expectations for September rate cut have shot up from 62% to 80% for rate cut on the 17th of September. In October, we see another one. A further rate cut coming with a 60% chance, having previously been down at about 31% post-Fed meeting. And then December, there's a chance that we see a third one, that currently sitting at 50%. There's even talk of a 50 basis point cut, which was started, I think, by CNBC.
Yeah, probably. But it's enough to believe it. I mean, if not after that jobs report, then when, I suppose, is the fair thing to say. Yeah. You can argue, and I was talking about this with Reuters on Friday, but is this just a sort of replica of last August when you had that vol scare with the Nikkei and the yen, and you had this brief sell-off in markets? It didn't take very long.
Yeah, that was like 48 hours, wasn't it?
Yeah, exactly. This one might be a bit more sustained, but this
is real.
This is real. You can argue
that's 3 months of.
If this is the Liberation Day stuff, the panicking from companies about tariffs and how that's going to affect things, how that's hit investment, then we will start to see this filter through in the months to come. But if this was kind of all the bad news is now in, and we see things maybe steadily recover in the next few months, that will be the key thing to watch, really.
25 basis point cut, does that stop a recession?
No, not really. If one is coming either way, particularly, I think. Yeah. And that's obviously all the things that we pointed out the first time they started cutting rates, was there are different types of rate cuts. There are good rate cuts and bad rate cuts. And there are rate cuts you're doing to sort of just keep the economy humming along nicely and not be too restrictive. And they're the ones where you go, oh, those are bad rate cuts. And then that's when you look at how the stocks perform around rate cuts, because it depends on what type of rate cut you're talking about. Yeah. If it's a 50 basis point cut, and usually when it's, and I know they did it last year, and I think it's probably was a mistake from them last year to go 50 when they did. But usually if you go 25 basis point cut or an increase, it's kind of saying, we're in control of this, we know what we're doing. If it gets to 50 basis points, it rapidly lurches into, oh, something's broken, we have to react territory. And that's not good for central banks to do, because it just shows you that the situation might be getting out of your control.
What suddenly starts to look a lot more attractive? My eye went straight to gold.
Yeah.
Because easing monetary policy, a slowdown in earnings, you don't want to be in the S&P 500 at 23, maybe 24 times earnings if you're at the start of a cutting cycle. Earnings being cut. And you're restrictive. You know, the neutral rate's what, 3.5?
Yeah. And the Fed is well above that. Really, if you look at the sort of inflation levels where the Fed is now, then you can argue policy is still restrictive.
So the brake is very much on, and is only going to be eased off slowly, right? December, we're still going to be restrictive.
Yeah.
So we've got, you know, almost negative jobs numbers. We've got the Doge restriction on hiring at government level. We've got tariffs only just coming. Yeah, to me, that's all.
I think you can spin a very strong bearish narrative about this that says people should be concerned. Now, again, because you've had this 2-day slump in markets, there's got a lot of that priced in the short term. Does that mean actually you get a bit of a continued recovery this week? It's really interesting if you look, and this is a very small data set, but presidents in their second term in the 20th century, you've never had a positive August. It's only about 6 of those in the post-election year, but none of those have ever been positive. So it's interesting that history is not on the side of a continued recovery for markets in August.
Okay, so August we should be careful for the next few weeks.
Yeah.
We're it's funny, we're getting a row in my ear. Chris Beecham, stop clicking your pen. It's because he's a nervous bull. The bulls are getting nervous. They're starting to sweat, click their pens.
You can't really be nervous if you've been given a 30% bounce in the Nasdaq and you get a 5% sell-off over 2 days. That's kind of how markets work, isn't it? The Nasdaq plunges to levels not seen since 2 weeks ago. You know, it's not exactly the most dramatic headline that's ever been written, is it?
Well, but that's an interesting point in that, yes, we're where we were 2 weeks ago, and suddenly we actually have found out that 3 months of really bad jobs numbers we've been lied to So
not-
should it be
we've
where
not
we are?
been
We have been
lied
lied
to.
to. That's the real number now.
Well, yeah, because the statistics have come in and the revisions have been made. It's not that the BLS is deliberately hiding this.
No, I don't mean lied to by the BLS. We have been lied to, and no matter what way you frame it, the market has been trading higher
On the wrong number.
on a fake number.
On a number that isn't.
So should we be up here, or should we be actually where we were 3 months ago? Because the economy's been bad.
But then, of course, we have to play sort of second order bingo, don't we? Because then we go, well, is the market now pricing that in so it can move on from that? Because the market's now looking ahead to the recovery of the improvement in jobs that we might get.
That's what I'm saying. You're not going to get a jobs recovery with AI coming in and rates still restrictive until December. The recovery starts in 2026.
Well, this is why payrolls next month will be very interesting. Not to trot out the tired line, but it will be the most important payroll reading since the last one. But it will be, I think, in the same way that earnings season is always the most important earnings season since the one we just had. And that's the interesting about this earnings season as well, because if you to talk to your point about AI, it's been a season of AI and tech companies doing reasonably well and okay in some places, and the old economy, the physical economy like Ford and this kind of stuff, still struggling. So the bifurcation in the US is somewhat concerning.
Yeah.
And our market's ignoring that really at the moment.
It certainly doesn't help the dollar bulls, does it?
No, and it certainly delivered a check to them on Friday, didn't it?
Yeah.
The dollar index slump, wiping out the substantial rally you'd had off the back of really people saying, no, there won't be a rate cut, and suddenly we're back again. And obviously the fact that the end decided to fire a statistics chief. And also it was non-markets news, but over the weekend it was revealed the Smithsonian's they've got an exhibit on presidents, and they've removed Trump's name from the list of presidents that seriously risk losing office because of impeachment. And he asked them to take his name off it, and they have done. So it's this kind of what is happening in the US.
He's been speaking to Erdogan, hasn't he? Asking for some tips.
Yeah, exactly. If I was going to be an authoritarian, this is how I'd go about it.
Yeah. Fantastic. Well, is Powell next? That's the big question. He said no. But when he is putting a 39% tariff on Switzerland just because its budget deficit with the US is 39 billion, then you start to think numbers are just being made up.
We've forgotten how bonkers the maths were around these tariffs in the original. It's just how they worked them out.
Love the tariffs.
Yes, everyone just agog at how badly they were done.
Yeah.
But yeah, a lot of commentary on Switzerland, people asking about that, how the Swiss market's going to open this morning, certainly, because to see that, I mean, the most inoffensive country on the planet, really, aren't they?
Well, how dare they export gold to the US when the US has asked them to?
Yes, all this kind of thing.
Nothing to do with them.
Successful pharmaceutical companies, all this kind of thing.
Yeah.
Our morning call on Friday was Tariff Man is back, and I think it's still the case that he's not gone away. Now all the news is now in. Is it back to deal making now? Is what people will now rush back to Washington to cut deals?
So they haven't been invited.
No. Okay.
So a little bit worrying. The Swiss have 5 days to rescue this. Futures currently looking down 2.4%. Swatch is looking down 5%. Richemont not much further behind it. UBS down 1.6% in the ADRs on Friday. But we are going to keep a watch on Switzerland. Not one that we usually watch.
No, I confess.
But we'll have a look at that at the open there. What else do you fancy having a little look check into?
Gosh, what's been going on this week? What's happened last week? So much. I mean, tech obviously was the big mover. We had 4 more of the Mag 7, didn't we? 1 more to go. Nvidia, which is still 3 weeks away or so. So that was perhaps the really popular thing.
Well, we've got
Amazon, the big loser, of course.
Yeah. Sorry. We got a little bit of brightness for you. FTSE looking up 40 basis points, CAC up 60, and the DAX up 40. So Switzerland really the underperformer there. Of course, closed on Friday for National Toblerone Day. And
the Hang Seng is something like 400 points off the lows, isn't it? So that again, if it is a recovery, this is how you'd want it to start. And I'm not saying it will be, but if you look at stuff like the Hang Seng, it found a low, and it had already collapsed, if you like, from the 24th of July highs at to 25,700. So we'd already had a decent correction in an uptrend for the Hang Seng. Maybe this is just the US and Europe playing catch up in a very short space of time.
Yeah. And then this is the Nikkei, if we want to have a quick look at how Japan's traded. That's over the past about 10, about two weeks. 2 weeks worth of Nikkei there. So giving up the gains on Friday.
It does make you think if this is how it's going to trade, it's a bit like 2017, that it has a couple of days of sell-off and then we go back to rallying. And as we've said before, that kind of pushes out the volatility to further in the future, and usually when it then comes, you sit on the pot and then suddenly it explodes. It will be much more dramatic when it arrives.
Yeah.
But it does feel like this is still a market that is, even with all the bad news, markets climb a wall of worry, blah, 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 that is still happy to rally. It's not a bad start to the week for futures, is it really?
Well,
it's not much follow through so far.
Oh, don't go against the Lord Art Cashin.
What's he said now?
Godfather of New York Stock Exchange. Well, he's not said anything.
Well, no,
he passed away.
Passed away, sadly.
But the market never bottoms on a Friday. If you close at the lows on a Friday, he always said, just be wary, step back, because Monday might be a bit tricky. Let's have a look at Bitcoin there. I see Poppy saying Bitcoin bounced from its key levels. Let's do a little 3-hour chart.
All the charts look the same, don't they? If you look at those daily charts, you've had a bit of a sell-off, and then it's already started. A 50-day moving average for Bitcoin, if you're looking at moving averages, that seems to be providing support, possibly. Maybe we'll put it down as trade of the week. Who knows? We probably won't, actually. But
Charting crypto, we'll have a look at it.
Crypto will undoubtedly cover Bitcoin. But
are you confident in $300 of EPS for the S&P 500 next year? Haven't seen these numbers.
No. I think you've got to be very wary about how the next few months pan out. But then, again, it is markets do climb this wall of worry, and they have weathered this quite well. Again, if we talk about the amount of money that must have sloshed out of US markets on Liberation Day and all the fund managers just cutting back, if you've watched it rally and rally and rally for 2 months and then suddenly you get a 5% drop in 2 days, you're going to think, I'd like to buy that now, please, because...
But that's the problem. And that's exactly why the futures are up this morning. It doesn't mean it's right.
No.
It means that everybody is in that mentality of, you only ever get a 2-day drop. This is a bargain. I'm going to go in, I'm going to buy the futures, and then boom, right in your face.
You're going to keep clapping to annoy the gallery. Is that what you're going to do? Yeah.
Wakey gallery.
But this is it, and you've had a spike in volatility off the July lows a couple of weeks, or just over a week ago.
So would the futures going negative worry you today?
Well, I don't.
The buy the dip, when we know that our good friend from our podcast, Mr. Spice, he is a buy the dip. He's a BTFD.
Well, you've got to be. There are dips and there are dips, and what's that line in Livermore's book about reminiscences of a stock operator? It says you can't tell till you bet, because they'd asked this old guy, I think they called him the turkey, and they'd ask him what he thought of something. He said you can't tell till you bet, and it's that kind of.
I like that. Polymarket's great for that. Yeah.
You just have to, sort of wait and see. And if you say you had a reversal in futures today that took us, I don't know, over the next week, 1,000 points lower. Let's be dramatic about this. Let's say the Nasdaq goes back to 22,000.
So 4%.
I kind of prefer that.
Right? Yeah.
I kind of prefer that than if it does just bottom now and off we go again. That would almost worry me more in the long term, because you have to have two-way action in a bull market. It has to go up and down. If it just keeps going and going and going, not only is it a pain to get on board because you just don't get dip, you just have to have it go up and down.
The S&P going back to 6,350 means that it literally is completely ignoring fundamentals now, and that only happens in one of these kind of
melt up euphoria phases. Things getting a bit silly, yes, and then eventually you have to pay the piper.
Yeah.
So, but that could, as we've seen so often in trading, if it goes and goes, you just it should have a correction. Well, it will do, but not when you want it to.
Yeah,
that's the problem as well. You might just have to sit and wait till, I don't know, October, November.
That's its patience. Yeah.
So what are you going to do?
Right, how are you feeling about August? Was the poll from producer Paul? 81,
That's the kind of answer I like to see.
81% bearish.
That makes me feel a lot better. That makes me feel a lot more comfortable about the market.
Yeah, 9% are with you.
Yeah, that's better. I like being a contrarian. As long as everyone's still not believing the rally.
It doesn't mean they're positioned that way. How many of the 81% are short?
Yeah. And they have to send in their client account numbers. No, we can't do that.
Good. Okay, it is 7:55 already. How did we get to 7:55? We haven't even covered Lloyd's yet. Let's cover Lloyd's very quickly because this is an important one for the auction. We are going to be watching. Lenders in car finance scandal brace for judgment from investors. But it was good news on Friday from the Supreme Court. So the Supreme Court making a ruling that the FCA now believes the redress scheme could cost between 9 and 18 billion, covering car loans back to 2007. Did you get a car loan in the last 18 years? You could be in for a bit of money if it's from Black Horse.
Have you read the RNS this morning from them?
No.
Okay, so it did say after initial assessment and pending resolution of outstanding uncertainties, it believes that if there's any change to the provision, it is unlikely to be material in the context of the group. And then it said, stating half-year results, we continue to perform in line with guidance. So it seemed like a relatively calm assessment. I think for the motor industry, this is probably a much better result than they had feared, I think, because it's certainly if you're expecting 10 grand in payouts and you're going to get 950 quid, you're going to be unhappy, particularly. But for the companies...
For me, and what Jeffrey said on Saturday as well, it removes the tail risk.
Yeah.
It has de-risked Lloyd's, which has been dying to break out, in my humble opinion, because I am definitely not a chartist. And let's have a look at the daily chart there. For me, this is a stock that's wanted to break out for months, and the thing stopping me owning it has been...
What happens with the car finance stuff.
Yeah. And that is now gone, so I am in the opening auction to buy these things with a top, of course, because I learned my lesson in legal in general. Is it legals?
I think so, it was, wasn't it?
Yeah,
No.
to go in at market. So I would say if you never go in at market in an opening auction, you will never be disappointed. Because I paid £2.60, I think, for them, and they were 2.48 bid within 3 hours. 7:58. So what do you want to do, producer Bill? Let's go through this.
Morning.
We'll do a guess the chart at 8:10, people. Morning opening moves. What do you think they are? We've got BP unchanged. Andrew McKelvey telling us about the big discovery there. IAG unchanged, raised to equal weight at Barclays, of course, after those great results on Friday. Lloyd's up 2%. Who's making these? They're up more than 2.
Well, caution.
Who's it? Singers. I will have 200,000 shares there, please. LSE commencement of a 1 billion share buyback, and Shell cut to hold at HSBC. Right, let's go into our opening bell in 1 minute. Right, go on, Chris. Take us through what else you're going to watch, because I've got my cup of tea to have.
Oh, there's
touched it yet.
A couple of other Close Brothers as well coming up this morning as well on the news. The Motor Finance and S&U was the other one. So those are probably the key ones to watch. Watch, of course, the farmers in the UK as well. If you've got Swiss ones under pressure, then the UK ones, GSK and Astra, could be key to watch for, I think, as well.
Oh, do you think?
Maybe just out of sort of sympathy, maybe.
They got spanked on Friday, yeah. And yes, we did notice the comment asking for more peers. God, you're a glutton for punishment. And yeah, Bill Blaine, absolutely fantastic. And Joe as well, Joe Clement. And last week, of course, Tom Price calling the 20% drop in copper 6 hours before it happened. Bell in your hand, please, Mr. Organ player. Terence, you like that, didn't you, Terence? Right, where are we? We're off and running for the London Stock Exchange on August the 4th. It's Monday. And we should be excited because Trainline is up 4.7%, not the one I was expecting to see at the top.
Choo-choo.
WH Smith up 2 point... No, I think these are just some wide prices. Barclays up 1.3. Small recovery there. But Barclays have car loans? Probably do, don't they?
Maybe have a little bit of exposure. But
Yeah. The Pru up 1% and BP up 1.3. BP didn't get hit that hard on Friday, did it?
No, I don't think so. What have we got?
Canal Plus down. We've got Bars Iron Brew weaker, losing its fizz this morning.
No, stop it.
WPP down a little bit, and Bats. You can tell it's a quiet weekend for me, can't you?
Watching the cricket.
And yeah, Halford's got a little bit boring at the top of the. Nothing exciting there, is there? BAE Systems trying to have a bit of a recovery.
Yeah.
As is Antofagasta, of course. There was that horrific move in copper hurting it last week. Glencore back above £3. Good to see.
Not much.
For the old ISA.
Not much doing. I mean, there weren't that many RNSs, as we said this morning, so it's quite thin news, I think. Fresnillo one to watch this week, of course, because it reports this week, and it's the best FTSE 100 gainer so far this year. So that's an interesting one. It's a slightly quieter week.
Now, Watches of Switzerland was down 7% on the back of that, the Swiss news. Let's have a look at how this thing's been trading, because of course there was bid rumours about 18 months ago, 2 years ago, because I had a little play on that and then wish I hadn't. And then, yeah, you can see it there. It got absolutely murdered on Friday morning.
Absolutely what?
Murder. There's been another murder. Watches of Switzerland. Is it because it's got Switzerland in the name?
I think it's got Switzerland in the name. This is how markets tend to work, isn't it, really?
But what an opportunity to buy those at £3.20, now £3.30.
I don't know anything about them coming apart from the name. They often crop up on the morning call movers, risers and fallers, which I tend to think is a very bad sign for most companies if they're always either in the top rise or top fallers on the 350. But
right, Lloyd's still in auction, so Singer's 2% we know is already wrong.
Swiss index holding up this morning so far at 11,613. So if there is a wave of selling coming, it hasn't materialised yet. It feels like a wait and see moment, really.
Right, Air France and Lufthansa, so the airline's strong. That's why WH Smith is up this morning. And we've got, Metal Water. That is up 60 basis points ahead of numbers on Friday.
Meta what? Meta Water?
The river of metal.
Oh.
Rheinmetall.
Oh, Rheinmetall. Sorry, with you now.
That is up 80 basis points. That's come off the highs as well, really, hasn't it? But it is time to have a look at Richemont. There is, so, down 2.4%. In Switzerland, actually much better than expected.
Yeah, what's the chart look like on that? Is it recovering off? It's a bit of a gap, but anyway.
Let's go to 3-hour chart there. Oof, yeah.
Oh, niche.
Go back down to April levels.
Yes,
really.
well, the Swiss index itself has been a very poor performer over the last. It's just not kept pace with everybody else. It's a bit more trading more like the CAC really than anything else. But the swatches, yeah.
Swatch down 3.6, better than expected though. Pre-market it was down 5. So right, let's have a look at Lloyd's. I'm obviously hoping for a lowish auction because I'm in to buy them. I don't want them to be. What does that? I put an 81 pence limit on. I don't think they should be as high as 81 pence. So I ideally don't want to be paying that. But I do think they should be, who am I kidding? I do think they're going to 80.
I mean, that's a very strong chart. That's a very good performance off the 2024 lows. It doubled in value just over 18 months.
If they open less than 79, I am going to buy more. So let's just get ready for this because we are, how many seconds past the 4th minute of the 8th hour are we? Come on. What is Lloyd's? What do you think Lloyd's are going to be opening at, people?
Well, this definitely wasn't the open we thought we'd get at about 2 o'clock on Friday afternoon, was it, really? really thought it would be a continuation.
Overall.
Yeah.
Yeah, and well, yeah, I've got to work out what my hedge will be if I open a decent Lloyd's position. American banks. Ooh,
Yeah.
Lloyd's. Is it still not opening?
Oh, there we go.
Ah, damn it.
Ah, that's right.
I've paid the bloody top. That's why you put a limit in. At least my limit at 81 pence stopped me paying 82 pence.
Oh dear. Deary me.
Right, 70. I will buy more at 79 though.
Up 5.6%. Wow, that market loves that.
Right, so that's me bought 25,000 at 70. Looks like 70. Let's see. But I have bought another 15,000 at 79.89, I think it was. So we're going to watch that one. How are Close Brothers, Chris Beecham?
Oh, that's one of them.
Up 27%.
Because this one is really motor finance. It's almost nothing else, is it? So
It was down 25%.
Yeah. So there's your leveraged.
So if you're a close brother, then I think the Supreme Court is another close brother of yours.
Yes.
Your friend this morning. However, it has oh no, when did this first come out? It must have been. It's exactly at the level when this first came out. £5. That was the 25% drop.
Of course, it was trading at £16 back in 2021. So that's been a lot of value destroyed there. But is that sort of a low there? I mean, if you're looking at levels, the high from August, September last year was £5.70. So that's where to watch if and when it gets there in the weeks to come.
Right, is Lloyd's going to manage to break out then? I'm going to put a few orders in to buy 15,000 at 79.5 on the buy side, and then 15,000 at 79 the level. Order by 79. Good kill, cancel. So I need to find a hedge. What is my hedge, Chris Beecham? Is it Barclays? Barclays is a potential hedge. Let's see. Since the start of 2024, Lloyd's is up from 47p to 80. So what's that? 85%? 47p to 80p?
It's in that kind of
33% gain. No, not quite. 75-ish percent. What is Barclays since the start of 2024? I'm not saying that the earnings have gone up the same, but just as a comparison website, we are £1.50 to £3.60. So Barclays up 125%, 130%. Wow. So Barclays up 130%, Lloyd's up 75% since the start of 2024. I think this has been what has been holding Lloyd's back, and I think 85 pence is in the sights potentially.
Yeah.
Still, I mean, it's still it's still going to be £1 billion hit, but they had provisioned 1.2.
Yeah.
And it's not going to be a 2 billion hit. That's
exactly. This is it could have been a lot worse. This is the market reading the positives into it, as ever.
Okay, I'm going to be responsible. I'm going to put on a little bit of Barclays as a hedge. How much am I in for? 15,000. So I'll put half Barclays hedge on, which is what, 5,000 shares, not 4,000 shares. 4,000 Barclays. I'm selling at 362.65 as a hedge against Lloyd's. There we go. 362.50. Where's the stop? Was ist sein Stop? Where's the stop?
So your school language lessons really coming in handy there.
That's at Wo ist. Jogger, help me out.
I was Spanish, not German, so you have to.
Go on then. What's Spanish for where is?
Donde está stop?
Donde está?
Do we have to do the accent as well?
Maturin will help us. Finito?
No, that's more Italian and finished, isn't it? So.
All right, so let's go back to the big moves then. Where are you making money this morning, people? You are making money. If you are
Oh, spoons.
Long a bit of spoons.
Gosh, they had a good update last week, didn't they? I think a very, very good set of numbers from them. Gosh.
Yeah, they had an extended auction, and now 5.5%.
Wow.
Must have been a good upgrade.
I didn't see.
We've been talking about it. My taxi driver told me to buy these, and that was a reverse.
It is
He
true.
says, I get a pint in there for £4.50. Where else do you get a bloody pint for £4.50 in Chelsea, mate?
He's not wrong, and the selection's often really good, actually, in terms of real ales, I have to say.
Don't tell me you go into Wetherspoons.
I do sometimes, because you get a better selection than you do the nicer pub next, the more classy pub next door. It's always London Pride, whereas in Spoons you will get more
Terence
beers.
has made a great point as well. It's exactly where we went in Gatwick Airport for our pre-Ibiza. Gatwick Airport, you're going to go to Wetherspoons.
Of course.
Yep. So, yeah, good point.
I wouldn't, but that's enough.
I want to buy more Lloyds. No need to build a position in the first 4 minutes, Rich.
Scale in, but not quite as quickly as
Yeah,
that.
exactly, yeah. TWAP. Or was it DC? Yeah, dollar cost averaging.
Yes.
Buy them all.
Not on the minute, though.
Right, it's time to go guess the chart. What country are we going to be in? It's a US stock, and producer Phil, let's go with his thought. He done me because Friday was one from my watch list. So I wonder
did you
if
get
he's... No, I didn't.
That's just on your watch list.
My
It's
own
too
watch
long.
list. So let's go
Voiced
down
by our own
to...
petard.
if you are wanting to avoid the stocks that I'm interested in, there we go, on the watch list. Rich McDonald's wants to watch.
Should we get that added to the platform?
So that is the platform.
On your platform, though. I meant generally.
Yeah.
Should get an official...
Oh, yeah. Wants to avoid.
Everyone's platform, yeah.
Well, no, we did have a think on Friday there should be longs and shorts, because I can't put any shorts in there. So these are just long-term, long ideas.
Right.
Right, what is producer... Oh, has he gone Occidental? Maybe. Let's have a little look. Like and subscribe. More Piers, more Bill Blaine, and more Claude Beecham. Martin laughing at the thought of Claude Beecham in a Spoons.
Yeah, but the beer's good, so that's where you go.
Is it after you come out of playing the organ?
Sometimes, yeah, post-evensong pint, yes.
Right, you ready? Where's Hamish? Hamish, give us a thumbs up if you're ready. 3, 2, 1, let's go. Right, welcome to Fast Markets. They still haven't told me. I haven't looked at the chat, and it's frustrating me because it was trading at $8 and then it's gone up to $14.50, almost 15.
And it's come off again.
I see it at the top now. Riot blockchain. I wouldn't have guessed that. I don't care. I'm not playing. I'm taking my ball and I'm going home. I would not have got Riot blockchain.
Father, when the test match goes badly, I said, asking me, "Are you watching it?" He goes, "No, I can't be bothered."
Yeah. Funky Gibbon, well done. Funky Gibbon is trading Riot blockchain.
It's just showed everything. Is that how this works? It just maybe they spend their weekend memorizing charts in case.
I think, yeah, Hamish and Funky Gibbon must be chartists, technical traders.
Yes.
Right, Judas Boyce should be called the watch out list. Rich McDonald's watch out list.
Why is Vodafone on your watch list? Surely it's already in your portfolio, so it shouldn't be on your watch list.
Yeah, but I don't think we could load up on these.
But you've already got it, so it shouldn't. It should just be in your list of stuff I have, shouldn't you?
Yeah, but that's what I mean. We couldn't. Some of those may or may not be in my ISA already.
Widows and orphans stocks, that kind of thing.
All of them. Right, Lloyd's 80.5, still not as high as where I bought it in the opening auction. Brilliant. But we managed to get some cheap ones as the sellers came out. But what are we here for? It's not to talk about current stocks, it's to talk about what is coming up this week. And our good friend Claude here, that writes this wonderful piece, The Week Ahead, is going to take us through. Where are you going to make money this week?
What have we got this week? I mean, it is Bank of England rate cuts expected on Thursday.
Is it 50-50? Is it 60-40?
No, I think it's now pricing is leaning very heavily towards a cut. So
thanks to the
latest
jobs numbers being lied about in the US.
Well, thanks to the latest numbers in the UK, yeah, they weren't great either, were they? So, but it is a UK heavy week of earnings, isn't it? Particularly if you scroll down.
Oof. Right, let's scroll down on this. Plenty UK names to report, including Fresnillo, top performer of the FTSE 100 this year. I would not have had that on my bingo card.
Yeah, there you go.
And then Lloyd's, right? So there we got nothing on. That's more your economic reports, isn't it?
So yes. Well, let's do economic. Let's do company numbers first. So you've got obviously the slightly less heavyweight stuff in the US this week, with all due respect to Palantir and stuff, although the key one to watch perhaps today because they're expensive. But you've got Fresnillo Intercontinental tomorrow. That could be interesting given obviously as an international company, it's got a very big swathe of rooms in Asia. So interesting one to watch there. And a very strong long-term performer that's taken a bit of a hit so far this year. AMD, of course, in the US. McDonald's, but you've got Glencore on Wednesday, Hikma, what else? We've got Legal & General, so everyone's favourite dividend payer, coming up on Wednesday. There we go. And then Eli Lilly and Gilead in the US on Thursday.
I think you're underplaying it somewhat. I think it's a very exciting week because none of these Magnificent Seven, boring. We've got
this is more of the actual economy, isn't it? Really,
exactly. Yeah, the trio on Wednesday really excites me. McDonald's, Walt Disney, and Airbnb. That is the American consumer. That is the global consumer, especially if they're fat and love Mickey Mouse.
Towards late, yes, turns towards exactly. And Caterpillar, of course, another one of those sort of bellwether stocks. Americans building, are they not building, that kind of thing. Another one to keep an eye on. And Pfizer. Yeah, I think it's not quite.
These are real stocks to trade rather than the
always go up stuff. Well, Palantir is a nod back to that, isn't it? Really?
Well, it's a big evening for me because I am. If we want to take a quick look at the portfolio, actually, I've actually made quite a big change. One that I would not have thought that I would be seeing myself in the position on Thursday, but I have
music from the gallery, please.
I've bought a lot of Apple. Now, as the market was selling off on Friday, I had bought some in the morning already because, as we know, I am very, very, very short S&P 500 through the short call positions. So let's just have a look at those and remind ourselves. I am short the... I've got, there's too many positions now. That's always a warning sign.
Getting a bit busy on that list.
It is, isn't it? Right, so we've got short the 6400s, the 6600s, 64, 65, 66, 68, and 7,000 calls. That adds up to a lot of calls.
Does anyone notice a pattern developing here?
That I am short the S&P. So, of course, I've lost quite a bit on those as they've been marked up. I'm also short names like Palantir. I'm short 80 of those stock, but I am short 300 shares worth of the 185 calls. Nvidia, I'm short 200 of the 200s and 200 of the 180 calls. So all in all, very short the big momentum junkie names that everybody who has never done a day's work on valuation in their life likes to buy. And
There speaks a sour person about that.
But however, Apple has now reported numbers. They were good enough, remembering the stock is down 15%?
It's down 19.2% so far this year, which is the worst of the Mag 7 after Tesla. It's down 25%.
So I've taken a little bit of a hedge in Apple here. I do not like Tim Cook. I don't like what he has failed to do. But I've now bought 300. However, it is, of course, I couldn't let myself just take the loss because my average is 209.5. So I've sold a lot of the 210 calls for August. So 600 calls I am short, which is 6 times 176. About $1,000.
Yeah, about 1,020, isn't it? So, yeah.
So worst case scenario, I'll take in $1,200 from being short the calls. But I am thinking that we'll get some kind of bounce in Apple up to about a 205, 206 kind of thing.
It's interesting with Apple, isn't it? Because it gets counted out so many times and then it does eventually go on and just rallies again. So you have to, I think a lot of the sentiment around Apple is, as you would say, Tim Cook has lost the plot. They don't know what they're doing. They are being left behind.
In AI especially.
Yeah, they are out of the game. And I think that it's always unwise to count them out, really. And at 30 times earnings, are they now a value trade in the Mag 7? Who knows?
True. Right, I've also pre-positioned myself for some Lloyds. I've short the US financials because remember, financials do not like rates going lower. So I have shorted a bit of those following the jobs numbers on Friday. And then, we're in the money on Lloyds. Brilliant. Lloyds is now 80.66 against my average in price of 80.4. So we've made a nice little £87 on that. And but finishing off, sorry, I'm scared tonight of Palantir. And therefore, I should probably close this short stock position and just run the short calls.
It might be more sensible given the way it's moving.
It's been bulletproof, and it was bulletproof on Friday, which worries me. If Nancy Pelosi is buying these, then
get out too soon.
Look
at that move. Look at that move. It's just bonkers.
And you get a retrace like you did on Thursday and Friday. You'd expect this thing to be a 149, 147. Yeah. So the market is telling me, McDonald, you idiot, don't be short these. So So I think what I'll do is I'll cover the stock position. I'll run the short calls, and then when they're up 5% later, I'll knock it back out.
That would work.
Yeah. I think I'll do that.
Tune in tomorrow and see how it went.
Yes.
But yes, you get a sense there's probably quite a lot of, shall we say, weak hands in this that aren't going to be very happy if it starts to have a sell-off, and then it could snowball very quickly, I think.
Yeah.
Here.
I'll give you an example, and this, I got a good friend in that does the content creating, right? Like we've had some of the people on, and Tom knows what he's talking about. He knows his investment, and his investment thesis is buy and keep buying, right? S&P 500 always goes up over time. Buy and keep buying. Don't even think about moving into anything else like the FTSE or Japan or India. You just buy the S&P 500 and you keep buying, right? Who's been right? Him. He went out with a video on Friday, which for me is asking the market to slap you in the face. He said, I've just made 4 times my monthly salary in a month on stocks from being long Palantir, long Nvidia. Yours. That is the red flag to me. When people are going out making 4 times their monthly salary in long Palantir and Nvidia, when they have no idea about stock valuation, you got it coming to you.
I mean, I don't know whether they can get my screen up, but this is the Google Finance screen for the PE ratio. Can we zoom in on that? Probably not, because I can't do zooming on my thing. That, here we go. 673 PE. That's not a typo.
Yeah, so it must be 67.3, surely, Chris.
They moved the decimal point. 673 times earnings.
But let's be fair. Let's look at the earnings expectations for like 2 years' time.
Okay, well then I need to
if we're actually being genuine on this,
up on this,
because I am guessing it must be like 80 times in 2 years.
Forecast multiples.
All right, if it's 80 times in 2 years, I'll close my short. If it's above 150 times, I am staying short.
Forecast PE. So where are we?
So full year 27.
154.
I've got to stay short that. 2 years out.
154.
And it's calendar year as well. So that's December 27. It's 150 times expected earnings.
That's crazy. But it's momentum. And I mean, if you look at, let's see what the earnings have done over the last, what's the income statement look like on Palantir?
And the revenue growth is only 40%.
It feels like it's come a very long way in a very short space of time.
Now, that's the kind of thing that makes me want to sell more calls and sell calls all day long. Because, you know, the stock's trading 154 and I can make 7% from selling $200 calls.
So it's making $30 million in June of 2023, 80, 106, 110, 140. So, okay, so there's a nasty drop there. But 223 in March.
Okay, so it's
the earnings, the income before taxes is going in the right direction. So that's
right. Let's talk about our good friend Figma, because
yes.
I don't know if you've got notifications switched on or switched off on your phone, but on Friday afternoon, I was sitting there clearly feeling relatively, you know, happy to take risk because the S&P was falling through the floor. So CRM, which you've seen Aisha Anderson on here before, sent out a text message to everybody's phone saying Figma is available for trading on the IG platform. Stock up 250% from IPO. So I tried to short it. And it said, you know, borrow not available kind of thing. And I was, why am I getting a notification if I can't short it? So I phoned up to have a moan. And they went, no, you can short it. How many do you want to short? So it was like, you put your money where your mouth is, McDonald. So I did. So I shorted 25 shares.
Right.
When something's moving 100%, so that's about $3,000 worth. And that was at 137. Managed to get short. And
dropped like a stone.
Within half an hour, it was at 125. You know, the ability to do that, because of course IG is long positions from clients, or IG clients have long positions, meant that you could short it.
Yep, exactly.
Which was wonderful. So, of course, small size and its availability, but it is always worth that phone call to the desk. Even being short 25 shares made me $250.
Yeah.
Which, yeah, paid the piper, as you say. So yeah, that's Figma. But let's have a chat about what exactly has happened in this stock, Chris Beecham.
Well, look at that move. I mean,
that doesn't even tell.
It says the half of it, does it really? That is to go 250. That kind of, it says two things. One, that there was a massive demand for it, but it does say, well, surely they should have priced this better. Surely there was an underappreciation there. Okay, you always want an IPO pop. Fair enough, it happens. But this is the kind of thing you read about in Chinese IPO markets.
Yeah. I remember we used to do Chinese IPOs for 100%. Yeah. And we were begging the broker to give us allocation up 100%. Up 250. When has a stock got up 250%? And of course, it was the bank's underwriting, wasn't it? It wasn't as if the company has benefited from this. The company has basically sold these shares to the banks for $33, and the banks have sold it to the market for 80-ish, 84.
So Adobe nearly bought it for 20 billion in 2022. There you go.
And what's the market cap now?
Pass. $115 a share. Don't know. Google Finance.
Should be in here somewhere.
This is good.
68 billion.
Okay, there you go.
Good. Right, that is how logical the US market and the retail traders are being at the moment.
Last check in on the indices, see how we're doing this morning. Where's the FTSE?
Market rip-roaring up 55 basis points, with the relief being...
See, FTSE 100 doing poorly this morning. Everything else happily rallying away. FTSE 100 just...
But it's hugely outperformed on Friday.
Yeah, exactly. So
yeah, the huge sigh of relief in the market from... Sorry, why is there relief this morning?
Well, I was reading this good piece from, what's his name, Rob Armstrong in the FT about the jobs report, obviously. And again, this is the funny thing about Trump having a go at the BLS, because most of the revision is because of the loss of government workers. Yep. So if you hadn't had that, things don't look great, but they don't look bad either. They look at the private sector isn't hiring. So yes, it is the government jobs. You wanted to fire government workers. Well, lo and behold, sunshine, here's your jobs report. But it isn't, as this pointing out, it's not as bad as it could have been. It's no real change to the overall story, which, okay, isn't showing a roaring economy, but nor is it recessionary. So it's kind of, everyone's gone away for the weekend. People have read the numbers. The dust has settled. It's not...
Buy.
Oh, come off it. I mean...
Right.
Gotta see where it goes.
Garth McKenzie time. We will let Claude go back to his desk and do his proper job. What's on the cards today?
Well, I've got some Bank of England previews to write and that kind of stuff, but also trying to watch the cricket on the sly. It's going to be fun.
Well, we do. We spend a lot of money sponsoring the team, so...
Yes, we keep an eye on it. We could get an hour's play and it could all be over, so you never know.
Great. Right, Garth McKenzie up next season. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Welcome back to our Expert Edge section with Garth McKenzie, of course, of Traders Corner. How you doing, Garth?
Hello, Rich. It's good. I'm good. Very, very good to be back with you. How are you doing?
Yes, very happy. For a Monday morning, there's lots going on. Lloyd's going through the roof. We were just talking about there. And then, yeah, how's the book doing? What's your view at the moment?
Yeah, it's interesting. I mean, we've started August with a crack to the downside, right? And obviously that came in with tariffs on Friday, and then of course that employment data on Friday as well in the US was weaker than expected. So we've kind of gone from this market that just seemingly goes up and up and up without stopping. That action that we saw into the end of last week, particularly Thursday and Friday. Thursday we had quite a big bearish engulfing candle on the S&P 500, and then Friday we gapped sharply to the downside. So it's like all of a sudden we're in August. August is a seasonally weaker month usually for the market. This sort of August to September period is seasonally a bit weak, and we've come in with a crack to the downside. So you kind of think, well, okay, so far it's doing all the right things from a seasonal perspective. And you can make all the arguments about higher valuations and tariff impacts now and what that's going to be doing to profit margins and who's going to pay the tariffs. Is it going to be the end consumer? Is it going to be the corporates? But all of these things kind of combine, right, at this point in time, at what is a seasonally weak time of the year anyway for the markets. And technically, it sort of confirms that we probably do have a bit of a bumpy time ahead of us, because I think it's going to take some doing to undo that technical damage that happened into the end of last week on the major indices. Those gaps to the downside were quite substantial.
Right.
And
a lot of pain.
And yeah, well, there was some pain, but it also, it probably was to be expected as well. These markets have had a hell of a big run off the April lows. And we had gone, I think it was 26 days in a row without a 1% movement either up or down for the S&P 500. Those spells don't last forever. And inevitably the market was likely to pause at some stage, and maybe that's where we are now.
Yeah, and as traders, that kind of stifles us a little bit, doesn't it? These 0.3% moves every day, it doesn't give us the opportunities to find where the machines are wrong. The machine's pushing things to the extreme, or overcorrecting, maybe a long fund trying to dump a position that it kind of felt like in Apple on Friday. That's one of the reasons I continued to buy them as they came off, was it felt like a Buffett was just unleashing or a long fund, because it's not often you have a stock with better than expected numbers, but you see the stock get crushed. So a bit more volatility in the market. It's a trader's friend, isn't it?
Well, it is. You do want a little bit more volatility. I mean, personally, I like some volatility. I don't like too much volatility, because obviously that can also take your head off. But these small moves, as you say, 0.3%, 0.2%, these tiny little trading ranges that we had been seeing in the last few weeks on the S&P do make it a bit tricky. But to your point about the earnings reactions to some of those magnificent 7 stocks that came out last week, it was very interesting to see the reactions, because as you said, both Apple and in fact Amazon as well were both down on the back of their earnings. Amazon also got punished quite badly, I thought, for what we, not bad numbers.
Right.
But then you go back 2 nights before that, or 1 night before that, and look at the way Meta responded and look at the way Microsoft responded. They both gapped massively to the upside, but then you saw those gaps being faded quite sharply immediately. So it was also kind of around the narrative of the broader market on the day, wasn't it? We had a strong market the day after Meta and Microsoft reported, and the market responded favorably. We had a weak market the day after Apple and Amazon reported, and they responded poorly.
But do you not think that was so Meta and Microsoft opened up on the highs, and then somebody somewhere said, right, this is as good as it gets. I'm out.
Yeah, quite possibly. Are you able to share my screen? Because if we do that, I mean, I've got, I had a...
Good stuff. Let's get that up.
See that. If you can see that. All right. I'm going to try and maximize it, although it seems like the maximized is coming up on a different window. Let's just work with this. I'll make it as big as I can, right, in this thing. But let's just quickly talk about them, because we start with, let's talk about the ones we were discussing a moment ago now. So Meta, first of all, as we said, gapped massively to the upside, but it faded that gap quite quickly soon afterwards. And like you said, it's almost like, right, this is as good as it gets. That felt very exhaustive in terms of the way it's shot up 10% after hours. And then it very quickly attracted selling. So now we've got that big gap, but that to me does look a little bit like an exhaustion gap in the near term.
Wow. And
it won't surprise me at all if we see the price drifting back into that gap. And yeah, there's a lot of support around about $720 now for Meta, where that gap comes in, or even down at 700, there's support. But it does kind of feel, to your point, that we've now seen, as good as it gets for the time being, and it's made this exhaustion gap to the upside, and now it's time to just settle down a little bit.
So for me, that's the perfect situation on Tasty for a strangle. Selling a 730 put and an 800 call, you're dancing.
Yeah, I mean, you could look. I'd be wary of being naked that put going into this time of the year.
Okay.
I would say, would you not? I don't know. I mean, would you not do
an iron condor?
If you're bullish, maybe you sell the put, but you buy a out the money put to sort of lower down put, and you collect the premium. I don't know. I mean,
good idea. So maybe do a 730, 690 put spread, but selling the call naked.
Yeah, that to me would seem a slightly safer trade, because you don't have the downside risk in that case, just in case we do see a deeper pullback in this weaker time through August now.
Nice. Great. Okay, that's Meta.
Microsoft was the other one we spoke about, which also had a similarly strong reaction. So huge gap up on the back of earnings on Thursday night, but almost immediately started selling off after the market opened, up at sort of close to $555 a share was where it opened, and it just drifted lower from there and continued lower into Friday's session. So once again, it looks like an exhaustive move to the upside, and it's now giving it all back and probably coming back into that gap. And that gap, that earnings gap, may very well offer some support, but certainly it was a really nice opportunity to get out of a long if you had been long into earnings.
That's it, right? And this is where, as a bear, you've got to be so stubborn, because Palantir, we're going to see exactly the same thing tonight, right? Look at that move from the last set of numbers in May, right? What do we go from 400 up to 525 going into it? And surprise, surprise, they came out with good numbers. The market's telling you they're going to come out with good numbers, right? Palantir numbers tonight are going to be fantastic. It doesn't mean they should go another 8% on the back of it.
Yeah. And that's the interesting thing about where we are right now, is that the markets come to expect good earnings. And look, having said that, the low earnings expectations had actually been dialed back a little bit heading into this earnings season. So they had set the bar a little bit lower. But what that means is that you really, really, really need to beat the bar in order to justify a big rally in the stock price. If you just meet the bar, you just meet expectations, it seems like the market's saying, well, thanks, that's nice, but it's not good enough. And they sell off the stock.
Yeah, there's no limbo dancing in this place. You've got to be Javier Sotomayor in this market.
Yeah, well, that's right, exactly. And you so it says something about the kind of market we're in, right? That it is richly priced, it is full, and there's no room for disappointment, or even anything that's on target is not really good enough. It's a richly priced market, and we're in a seasonally weakish time of the year anyway. So yeah, I think when I was with you in the studio, we talked about dancing close to the door, and I think that's still valid now. I think you've got to be cautious this time of the year, and also just seeing the way a number of these stocks have been trading following their earnings reports. Just be careful.
We got a question from our good friend Neil away from the numbers. What do you think of Reddit when it comes to these kind of situations where it?
So let's have a look at Reddit. I mean, I'm going to come back onto my IG screen, or you've got it up there, Rich. So
cracking numbers.
They were cracking numbers, and I never like to blow my own trumpet, but I did put out some analysis last week to clients that follow my work, and said that little setup that we were seeing there looked like a cup and handle pattern.
Oh, well done.
It was kind of building for a potential breakout, and that actually, if you wanted to play that earnings move, if you believed it was going to break to the upside, the way I would have looked at it would be to buy a short-dated and at-the-money call, and that would have done very nicely for you on that breakout. So some of them work, some of them don't. But the thing about doing that and trading it that way is, if you buy a call option into a setup like that, and you buy a close-dated, near-dated one, so it's not a lot of time value left, you can then you can see those calls gain in 3, 4, 5x on a move like that we saw in Reddit.
Just
and
take
know that your downside is limited to the premium you pay, really.
That's a great call. Just take us through this term that you introduced, the cup and handle. I've tried to set it up for you there on the chart.
Well, okay, so just zoom out a little bit on it, if you would. The cup and handle pattern, there we go. Just mainly because I want to see that spike to the right-hand side.
Yeah, sorry, I know. I was saying beforehand. So
beforehand, right.
So going into it, what were you looking at?
Okay, so if you look at it in terms of you've got that on the left-hand side, you had like a big rounding bottom type of pattern. Now that is what we refer to as the cup. But if you just go a little bit further out, Rich, I'm looking at it from a bigger picture perspective than what you are.
I got you right. There we go.
So I'm looking at it. If you go all the way back to March, you see that rounding bottom pattern there. Right. So you've got a huge, nice, big rounding pattern. And then you come up to the peak in early July, and then it does another little dip into July. So that big rounding bottom that I'm talking about since March, from March until July, that's kind of the cup part of the pattern. And then on the right-hand side through July, where you've got that little shallow dip, that's the handle. It's easier if I could draw a picture.
So the handle's on the right-hand side.
Yes, on the right-hand side. Correct.
That's where I've always gone wrong. I've always looked for the handle on the left, and then.
Are you left-handed, Rich?
No, I'm ambidextrous. I'm bad with both. Okay, so that set you up beautifully to notice that was the chance, and then you see the huge breakup. And just in terms of that, means that the demand's there because it's been trading a low range. But the seller's there as well. And any good news is going to wipe the seller out, and you've got, hey presto.
Well, that's it. And particularly that action through July, what you saw there was that every time the price dipped a little bit lower, it was met with buying interest at the lower levels on each daily candle. You've got on the daily candles there, you've got long wicks to the downside, which indicate that the price trades lower intraday, but it doesn't stay down there during the day. It trades back up into the close. So what that is telling you is that there's buying action at the lower levels. There's accumulation happening at the lower levels. And when you get that type of trading action, it's worthwhile to pay attention to it, because it does kind of indicate that there is underlying strength there. There is buying happening under the surface. And when you get a catalyst like we did with earnings there for Reddit, that can be the thing that sets it up for a break higher, which in this case, it did very, very spectacularly.
That's where I really buy into technical analysis, because that's exactly it. Every single time this stock went lower on the day, there was a buyer there. And that makes a lot of sense from the psychological side.
Yeah, and that's what I like about technicals, is that it's a read of the dynamics between buyers and sellers in the market. You're saying, well, what is the chart telling me? It's telling me where the buyers are, it's telling me where the sellers are, it's telling me where the levels are, where this price might break support or where it might break through resistance. And all of those things, to me, as a trader, I find technicals incredibly useful. And I'd say that 80% of my decision making is based on technicals. Obviously, keep abreast of the fundamentals and know what's going on. But I find trading off of a technical view far more useful than trying to trade a fundamental view.
Well, definitely, and the market's given up on fundamentals a long time ago, until days like Friday. And days like Friday, suddenly you get 6 hours of the way that markets were designed to be, with logic coming back into it. What else have you got for us on the screen there?
Well, I mean, if I continue to share those slides, we've had a look at Microsoft and we had a look at Meta. Let's have a look at the other two, which had a negative reaction to their earnings. So Amazon, different story, right? This was setting up it was trading quite a bit higher, and then you got that big gap to the downside on Friday after earnings on Thursday night before that. That gap now, again, I think that is quite significant technical damage that we've got there on the chart of Amazon. You may find that the price pops up a little bit at some point, but I think that you're going to find that a lot of resistance comes into this gap if it does perk up a little bit. And it's not to say that I'm turning bearish. It's just to say that I think that bullish move that we'd seen from April through to the end of July, where it was just going up in one direction, that technical action, that trading action has now been completely knocked off kilter. And it suggests to me that we've probably got some corrective period coming ahead of us here. It might be a bit choppy, it might trade a little lower and maybe go and flush the 200-day moving average down there, which is at about $209. But I just think that bullish action that we had seen in Amazon leading up into earnings is now the thing of the past for the foreseeable future here.
Okay, so again, that's giving me the confidence to sell $230 calls.
That I would say is probably fair, because you've had the bullish, or not bullish because it wasn't bullish, right? But you had the catalyst that could have been bullish for the market, for the stock, and that catalyst is now out of the way. So the likelihood of it going all the way back up there in a hurry, to me, seems fairly remote.
But again, a lot of smart people saying, "Oh, it looks a little bit overdone." It's been cuffed, and then it's had the negative impact of the market coming off as well. So it's got a double whack. So I'm looking 210. I'm looking like bit of compensation.
Well, 210. There's quite strong support there. That's where the 200-day moving average comes in. So there is a bit of support down there. So you may well find that the buyers step in around about that sort of area and maybe take it up a little bit. But you probably, my best guess at this point is that it would probably track a range now, with 210 being an area of support, up to as much as 230 maybe being an area of resistance, where the gap is. And then and to see the price chopping around in that sideways sort of range in the foreseeable future wouldn't really surprise me. And again, particularly because seasonally we're in this kind of bumpy, quiet northern hemisphere summer time of year for the market, broadly speaking.
See, these are nice trades. I'm just looking, if we can just switch quickly to the Tasty platform. 46 days away, of course, the mighty Tom Sosnoff saying 45 days is your kind of ideal time to put a trade on. So we've got the September expiry, now 46 days. I can sell the 205 puts, so give myself a little bit more safety. I can take in $4 there, but selling the 230 calls, I tell you what, let's go out to 20 delta, $235 calls. Suddenly, in 45 days' time, I'm taking in nearly $7.
Yeah.
And that $7, what's that? Over 3%. It's quite a nice return, isn't it? For
it is.
Let's see. Yeah, my margin. It's not ideal, but it's not going to break the bank. 3,200 on the BPR, but I'm taking in $700, and all I'm doing is saying, right, I tell you what, I would buy Amazon at 205, or I'd short it at 235. So yeah, I quite like that one. I'm going to put that on this afternoon, Garth. Thank you for that.
Okay, good. Well, let's keep in touch and see how it goes.
What's our next one?
Well, the next one was just to look at Apple, because that one also had a negative reaction to earnings last week, and you can see there it's really been sideways in a range for the last 3 to 4 months, really, between $195 and $215. And in fact, on a relative basis, this is one of the Magnificent Seven stocks that really has actually underperformed the rest of them quite notably. This and funnily enough, the other one is Tesla, which is also underperformed. But Apple had a negative reaction to earnings the other night. It traded down on Friday, and you can see right now it's dipping underneath all of those moving averages. So we've got it now below the 50-day moving average, which is my medium-term moving average. It's been below the 200-day moving average already for quite some time. And it's now dipping underneath those shorter-term moving averages as well. So in my mind, I think this thing is likely to head down towards 195, where the bottom of that sideways range comes in.
Yeah.
And then we will see at that point whether the buyers step in to defend the stock or not. But yeah, on a relative basis, it's definitely the weakest of the Magnificent Seven stocks as far as I can tell. And we've had a negative catalyst now, negative in inverted commas, in the sense of earnings that kind of were a little, poorly received, let's say.
Well, that worries me. I mean, I'm assuming it's going to be up 1% today with the futures higher. What changes, we're going to find out in a minute as well. Do you mind staying with us for the US Open, Garth?
Yeah, sure. No worries.
Brilliant. So yeah, be another 5 minutes. Let's go to the US. Oh, session's open, and we'll continue to talk about Apple.
Cool. I'm just going to close. I don't know if you could hear that lawnmower in the background. I'm going to go and close all the windows. Oh, sorry. Oh.
No, that's brilliant.
Live TV. There we go.
Is that somebody cutting your grass for you?
I usually cut it myself, but not this time.
Have you seen the movie Magnificent Seven, Garth?
No, I haven't.
Well, the big question is, who is going to be the Bernardo? Because Bernardo was the first of the cowboys to be killed. Who is going to be the most likely Tesla, I would imagine? But who is going to get knocked out of the Magnificent Seven? What will the next name be? There's Palantir opening up 1.8%, not letting me get out of my short position there. AMD as well up in my face, 1.5. We got Uber shortly up. Amazon, I wanted to see Apple somewhere on that list. It's not going to give me it, is it? Where is Apple opening?
There it is.
0.5%.
0.5%.
Dismal. Absolutely dismal. That is worrying me straight away.
So that shows you as well, then, Rich, there's relative weakness there as well. When you've got the others all up 1%, that one's only up a 0.5%.
Yeah.
Just shows you there's relative weakness there.
Exactly. Let's continue down Alphabet again. Relative weakness there. Berkshire Hathaway. Keep an eye on that one because, of course, we had the markdown in their Kraft Heinz stake at the weekend.
Yeah.
So that one.
That's interesting. That Berkshire's interesting for me. It's something I've been watching because since Warren Buffett announced his retirement, which was on the 3rd of May, the stock is down about 12% since then.
Is it really? Wow.
Yeah, and if you actually look at the underlying holdings in the portfolio, they're not down nearly as much as that. And I mean, obviously, he's the Oracle of Omaha and he's the legend. But
in the market every day, isn't it?
Yeah. So I think that it potentially lines up an opportunity to accumulate this stock with a medium-term view. It's not one to trade actively, I don't think, because it doesn't move that much. It's not that volatile on a shorter-term basis, really. But
yeah.
But I've actually started to accumulate the stock into weakness here with a longer, in the long-term investment portfolio, on the basis that I think it's this weakness is probably not really justified.
I've never traded it actually because we were always scared to, because of course when I was working at the hedge fund, it was before it had done the share split. So you could buy 10 shares and that was like $4.5 million worth. So you always, we'd be buying 10,000 of Renault or whatever it was. Whereas you buy, 10 shares of Berkshire Hathaway. If you accidentally buy 1,000 shares, you're getting a call from the risk manager. So sure. I've always stayed away from it, just scared. Right, there we go. Only stock down in the day, really, along with the 20-year Treasury bonds. So yields higher. Just a whole load of relief coming in from after Friday's move lower. Intel got hit quite hard. Intel got, again, it's been an underperformer. It had the numbers that weren't taken well, but it was hit again on Friday. So maybe we are seeing some opportunities in the market there.
Yeah, maybe. Intel just really, in terms of the semiconductor space, has just been very disappointing for a long time, hasn't it? You've got the likes of, AMD, NVIDIA. There's just a lot of these bigger other semiconductor players that are leading that space. Intel just doesn't seem to be in vogue at the moment, does it? No.
Okay, so Amazon up 1.2, Airbnb ahead in numbers, and nothing too surprising there. Let's have a look across at the tier 2 stocks, the more dangerous ones, I like to call them, Garth. And we're seeing Strategy have a good bounce.
Yeah, it got sold down quite hard into Friday. In fact, I had been long and I got stopped out of it. And I think I was stopped out at 387 when it dropped on Friday. And I'd been in from about 400 odd. So, you know what? Sometimes you look at it and you say, well, I'm very glad I had that stop loss in place. And that was one of those days because I lost a little bit of money that was within risk limits and all that. So all good.
Exactly.
But you kind of, no one likes to take a loss, do they? Even if it is within your risk limits. And
helps to reduce your risk if you use it correctly.
That's some wise words from Axel Rudolph. Maybe we can hear them again, can we?
Helps to reduce your risk if you use it correctly.
There we go. I like that audio clip. But yeah, I mean, the thing about it is, when you execute your stop loss and then you see that your loss would have been significantly worse had your stop loss not executed, that's almost when you kind of want to give yourself a little pat on the back and say, well done. That was good trading. You did the right thing.
Well done for doing your job.
Yeah, well done for doing your job, and know that not every trade is going to be a winner. I know statistically about 4 out of 10 of my trades, on average, 3 or 4 out of 10 are losers. I know that. So when you have a loser and it's within your risk limits, you just say, well, that's part of the business.
Yeah.
Yeah.
Yeah, that's it. Well, I tell you what, that's the US all sessions open. I think we've pretty much covered. We've got a markup on the back of futures rising. Maybe the sell-off was too much, but we have been talking about Lloyd's this morning. Garth, would you mind taking a look at Lloyd's, because we don't have Axel Rudolph here, unfortunately. But as our stand-in technical expert, if you will, we've got Lloyd's now up 7.8%, 81.60. You can see here it's been trying to have that breakout for a while now.
Yeah.
What do we do here? What's that chart telling you?
Well, look, so we know the reason why it's up, right, is because there was that court ruling on Friday with the vehicle financing scandal, if you want to call it that, which seemed to rule favorably towards the banks. So you've got all of these banks that were exposed are all up quite nicely because the market was expecting a worse outcome. And I think a number of these banks had also started to make provisions for what they might have to pay up. And we come in this morning and suddenly realize, well, okay, it's not as bad as what was expected. Therefore, you get this huge, big move to the upside. Lloyd's is one of them. There's another one that I'm following, which you'll recall from your days in South Africa, Rich, which is First Rand, because that has an exposure as well.
Oh, does it?
It does have an exposure to its UK through its UK arm, and that stock is also up about 5% this morning in sympathy with in response to this legal ruling. There you see, but notice also how what it's doing. It's gapped up, but it seems to be trading on the low of the session at the moment. First Rand. So
what's its UK entity? Sorry, Garth.
It's got the whole Eldermore and that side of it.
Okay.
Which is where it's exposed there. So in any case, it was the one South African bank which actually has an exposure to this UK vehicle financing scandal. So we've been watching that very carefully and watching for a possible breakout there, because there is actually an interesting technical pattern as well on First Rand. There's an inverse head and shoulders pattern there, which is validated on the break above 77 Rand per share. So we were watching that as a potential breakout area, but this was also always going to be the catalyst for it. And again, it was one of those situations heading into the end of last week where we figured the company's made quite big provisions already for this. What happens if the court ruling comes out and it's not as bad as feared? And that's what we've got. And hence you're seeing these big moves to the upside on these stocks where it's bad news, but it's not as bad as what could have been. So therefore it's good.
Interesting. I haven't traded First Rand for 13 years now. What's the rest of the business like? Because this used to be the darling of the sector.
Yeah. Well, it still is probably it's not really the darling right now, I think, but it's a good operation. They're a very solid outfit. They're always ahead of the game in terms of technology. They're a more innovative bank than most of the other big four, really.
Right.
So it is still a favorable play. What's really interesting, though, Rich, is right now in the banks in South Africa is the dividend yields that are on offer are insanely high at this point in time. And some of those banks are giving you dividend yields of 8%.
No
plus.
way.
And you've got a situation right now where the dividend yield is higher than the PE ratio on a lot of these South African banks. It's incredible. The very deep value there. And they're well regulated. It's a very, very well regulated.
Oh, yeah.
It's a solid financial sector that they've got there. So these are not rubbish businesses. These are quality businesses, very well managed, very well regulated. And you're getting these enormous dividends on offer, very cheap, the valuations. So
Good.
it's interesting.
Okay, wonderful. It's a great heads up there. Thank you very much, Garth, for joining me in the extended version of Expert Edge with all sessions thrown in as well. Chris Beecham coming up with today's trade of the week. Garth, any other diamonds for us as we say goodbye?
Well, Rich, you and I, when I was in the studio last time, we spoke about cable breaking
yes.
down, and we were both off air. I think we talked about options trades that we've got on with that, looking for a weaker pound and a stronger dollar. That looks like it's working out okay for us, isn't it? So yeah, I'm still seeing cable heading lower. I think it's heading down towards 130 odd, and that would be good. Would pay for my holiday coming up.
Nice. Well, it's an interesting one, and of course a big week with the Bank of England rate decision. But it looked like it was heading on its way to 130, but then of course we found out that the US is actually going into recession, so they might be in as much trouble as we are. But we'll see. Garth, thank you very much for joining me as always. That was wonderful. We would love to have you back on a Monday. Yeah, we'll see you soon.
Thank you, Rich. Have a good week.
Cheers.
Okay, guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat, come on. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns. Cash returns, come on.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Bring me the next shiny new thing. Bring me the next shiny new thing.
We're watching a crisis unfold in the UK and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings-first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs, from scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
Okay, guys, before I teach you how to use this,
Hello and welcome to Trade of the Week for the week beginning Monday, the 4th of August. Yeah, August is upon us. Where has the year gone? let's look firstly at this week's trade of the week. We're going to go swiftly into this. This one's especially for Rich McDonald, this one. We're going to go long the S&P 500. Yes, it might seem foolhardy after those job numbers. It might seem like we're just continuing to ignore the bad news. But if you look at this, you've got a recovery over the past, well, a very strong recovery in early trading this morning, and Sunday night's trading very good as well. So we found a low for the time being. That's the key thing here. We've been given a level against which we can trade. And crucially, if you look back to early July, all the way back to a month ago, it was an interesting area because we saw around 6,200 the buyers step in. Whenever we got close to this, as you can see on the 7th of July, if you look to the 16th of July, this is where the buying materialised. So 6,200, your line in the sand, as ever, will give it just a bit more room to breathe. I know it's one of my cliches, but it's still true. You could even maybe nicely got a 50-day moving average coming in here. So we'll go for 61.90 as our stop loss on the basis that if it does reverse, and if it does continue to fall from here, hits that stop, our view that it will now bounce and move higher has been negated. So that's how we're looking at this trade. We're not saying it will go for another 6 months, but if you're looking for a trade of the week, it might well be that some of the negativity around these numbers from Friday has been overdone, shall we say, and that we might see the market continue to recover. There's still a lot going on this week, plenty of earnings coming through, not quite the really heavyweight stuff we had last week, but enough to keep the market busy. But so the trade of the week for this week, long the S&P 500 with our stop at 61.90. Now to look back to last week's trade, not a bad one to start off with. It was long US crude oil. That bounced nicely, particularly on Tuesday. Reports of Trump imposing fresh sanctions on Russian oil, on buyers of Russian oil in particular. But then, of course, you had the reversal on Friday with those poor job numbers. The question, of course, is now, we're still higher where we were a week ago. Can it continue to move up from here? You've had OPEC reportedly increasing production as well. So we'll see whether that one does continue to move higher, to one to keep an eye on. But that, of course, just go back to this week's trade of the week, by the S&P, long the S&P 500 with our stop at 61.90. And now if we move on to technically speaking, let's see what we've got on moving this week. We'll start off just with a brief look at the indices. I think it makes sense, really, given what we've seen. We were talking about the S&P in trade of the week. If you look at the Dow here as well, again, a very strong recovery off these lows, currently trading at 43,800. The low from Friday was 43,300, so a 500-point recovery already. And crucially, if you look at this, your low from the 16th of July was 43,753. We're back above that, not close to above it, we are back above it. So it's interesting already to see the market trying to recover some key levels. Quick look at volatility as well, of course, because here, is this a more sustained bounce? Is this the beginning of another reverse? Because, of course, selling the spikes in volatility has been the way to go since mid-April. As you can see, these rallies, 23rd of May, if you want to call them rallies, these spikes in volatility, late June. This is the first one we've really had from a very low level for vol, so it'd be interesting to see whether this one continues to reverse. So if you're looking at your charting, that's a key one to watch for, that if that continues, usually you'd expect equities to continue to recover from here. So that's the picture we're looking at on volatility. But let's move on to our requests, and don't forget, as they say in the chat, to get the requests in nice and early as well. The earlier the better, really. Let's start with the first one which came in, which was Glencore. So let's do Glencore this morning. Of course, reporting numbers this week as well. So one particularly to keep an eye on. Up just a little bit this morning, about 70 basis points in early trading. Where are we now? Let's look at the long-term view for Glencore, which is always a good thing just to get a sense of where we are. Weekly chart doesn't scream optimism, it has to be said, because though you've had, as so many stocks, the recovery from these April lows, if I could really, recovery from April lows is a sentence that just gets uttered more and more at the moment. But for Glencore, yes, it's come off these lows, but also we really saw some selling come through last week, unsurprisingly. So is this the beginning of a more sustained move to the downside and continuing that weekly downtrend, which has been in place here since early 2023. It does sort of go in fits and starts. You can see sharp move downwards, drift, sharp move, and then a bit of a bounce. This is the latest bounce, the most sustained we've had for Glencore in some time. It doesn't look great though. There's your daily chart. Nice downtrend if you can get it. Of course, moving averages all pointing lower. Sustained rally for the time being. Interesting one, because if you look at the weekly chart, you can argue, okay, it's rolling over. We could be heading back to the downside, maybe a move towards these lows of early April back in play once again. If, on the other hand, you want to take a longer term view, you would argue there's been a fairly constructive recovery. Notably, can't get my words out this morning. We're staying and holding above the 50-day moving average, which we weren't able to do in September. So you had a bounce there, and eventually it gave way to fresh downside. But you can see there the weakness in late June, then found support just above the 50-day moving average. Again here this morning, up 0.75% in early trading. Is this another higher low? Because it's interesting how this is really sort of provides you with two different views. So on the weekly chart, it's hard to argue for a bullish view. But if you look at the daily chart, maybe the short-term outlook is still positive. You had a bullish crossover here on the moving averages, still below the 200-day moving average though. And as Paul Tudor-Jones always said, bad things happen below the 200-day moving average. So we have to wait to see how that fares. And of course, our line in the sand for the time being, £3.30 a share. That was crucial in early March. One to watch for again over the next few weeks if we do get back there. Moving from one sector swiftly to another poor performing one, UK house builders, Bellway in particular. A bit of a clanger on this one, I think. Yeah, there we go. Let's look at this. Again, I always start with a weekly or monthly chart just to get a sense of where we are. And a whole lot of nothing from Bellway over the past 5 years, which is quite impressive. A lot of house builders look like this in the UK. Big drop early 2020, unsurprisingly, for reasons that we all know far too well. And it hasn't really gone anywhere. It's had rallies, decent rally late 2020, early 2021, miserable year in 2022. Steady recovery since then, it has to be said. But then, again, we just haven't been able to hold those highs. So for Bellway, the weekly chart isn't exactly encouraging. The daily one doesn't get much better either. It has to be said, if you look at this, it's an impressive lack of performance from Bellway to be essentially where it was. Gosh, if you go back to May of 2023, there is this oscillation in the price movement. People clearly picking it up when they think it's cheap, but then dropping it again like a stone or a hot brick when it becomes too expensive. Maybe you can hope that this is the formation of a short-term low here. You had a lot of appetite to buy around 2,200, but it's not exactly particularly encouraging, I think, for Bellway. It's really interesting how the UK house builders, there's so much talk about house builders and house prices and how expensive they are, and no one can buy a house. You'd think it would be good for the house builders. It really hasn't been, and so not a great performance from Bellway. Some signs of buying, as I say, around this 24.60 level, but the short-term move, even leaving aside what we've had over the course of the past sort of 2 years, is not particularly encouraging. A good one coming in this morning because, of course, a hell of a news-driven move here. Close Brothers, 20% gain for a share price off the highs, because we were testing over £5 a share for the first time since September in Close Brothers, but just unsurprisingly a bit of profit taking coming through there after that big gap higher. Let's look at this weekly chart. We did look at this chart in the morning show, and how, of course, you've seen this huge amount of value destruction from £17 a share down to £2 a share. The brave bargain hunter stepping in late December, maybe hoping against hope that the resolution would not be as bad for Close Brothers as feared. So again, weekly chart, you'd be saying lower high. There is a reason to maybe to look for the short positions because you've got an area to trade against. But of course, on the daily chart, yeah, bit of a different performance. Again, this has an interesting steady uptrend that has done better than the early 2024 one, which took us back to the 200-day moving average and did get above it before. Unsurprisingly, fresh bad news coming through, driving us lower once again. But we're above the 200-day moving average here. Moving averages all pointing higher, which is a solid sign. Maybe some of this froth comes off, heads back towards £4 a share. Those brave enough to buy on Friday, clearly there were some buyers on Friday doing quite well out of this move. So a slightly more positive move to the upside there. And then I think Mobico is an interesting one. A lot of requests this morning, a lot of equity focus, which is good. Mobico Group. And comes with a comment, sale of US business now complete, new CEO, bouncing from the lows, but he already knows what I'm going to say before I say it, because yes, not really a widows and orphans stock, is it, this one? Cheap, but cheap for a reason, perhaps. As I confess, it's not one we look at very, very often, but look at that from 2020 at £4.70 down to 30p at Aston Martin levels of shareholder destruction there. Nonetheless, constructive price action in the short term, if that's what you're looking at. If this move continues, if we see it pushing on from here back to 45p, which was the key low from June of last year, there was the area where the buyers finally stepped in. You got a bit of a durable low until, of course, this profit warning in April. We saw last week the rally top out of 40 pence a share, so there's your sort of short-term line in the sand. But noticeable that your momentum, as measured by stochastics, remain relatively strong. So though you had a bit of a pullback from 40 down to 34, it started to recover, and that suggests that maybe there's a bit more buying pressure coming through here. If you want to draw downtrend lines, if you want to be that brave, it doesn't, of course, bode well for you, because you're kind of, yeah, I think that's not a bad trend line. A couple of touches of it. There's your line in the sand maybe to watch then. Back above 38p, back above 40p, and you can maybe breathe a bit more easily. I don't really draw trend lines very often, but I think it's perhaps a good, useful one coming through in here. BYD, can we look at BYD? Yes, we certainly can. Live television, great when you just watch me type things in. See there, you've got to love the uptrend. That's lovely. That's working out really, really nicely. A super breakout. Very much euphoria clearly coming through here at the peak of the Tesla troubles. BYD was going to conquer the world. Tesla was doomed. Some of that euphoria has been reversed. But if you're looking for a bounce, the 200-day is probably a fairly decent place to find it. That may be the case here. Maybe with some of the more positive news coming through, or the positive atmosphere, I should say, coming through markets this morning, maybe there's a hope that we can find a low at these levels. So yeah, the 200-day moving average, if you're going to use the moving average as support, the 200-day is a fairly good one to use. Seems to be the way it's working out at the moment. Of course, it's interesting for a share price that, again, has essentially gone nowhere since February, working out a lot of this froth. Is that cleared? Can we now see perhaps a more sustained move to the upside on perhaps a more reasonable assessment of the situation? Seems to be that way. Of course, this is how you should look at charts. They're the market really endorsing or not the prospects of the company. At the moment, people clearly think BYD has been overcooked for a while. A lot of the hype has gone too far. The euphoria of seeing them advertised in the West and how they would eat Tesla's lunch seems to have been overdone. Watch to see whether this one, it's not really a low yet because it hasn't really started to move higher. Don't forget, for a pullback to transform into a move to the upside, it has to stop going down. It looks like it's stopped going down. It's not started to move higher. I think the problem a lot of traders face is that they move in too early. They think, oh, that is the beginning of the move higher, where it's simply a pause in the downtrend. For the time being, it hasn't mutated into the caterpillar of the downtrend, hasn't turned into the butterfly of an uptrend, if you like. There's a tortured metaphor for you on a Monday morning. And then last one so far, Mondi back into, packaging. Is that what Mondi does, I think? I could be wrong there. It feels like they do packaging. I could be very, very wrong on that point. Mondi, oh, which one should we go with? Must be this one. It is packaging. Thank you, gallery. There you go. My sad knowledge doesn't let me down. Key points. Packaging and paper, more exciting company. It would be hard to find, really. Again, gosh, people do love their dip buys, don't they, really, on this one? A stock that's been getting cheaper and cheaper and cheaper, and there's the sort of hope dying away with each bounce. So clearly, there's something around the 1,000 level, £10 a share, that is exciting people. Maybe some hope springs eternal after this drop on Thursday. Was it profit warning? They must have had a profit warning last week to cause that move, because that's a nasty move in the share price. But very much downtrend here, reasserting itself, unsurprisingly. So maybe you get a bit of a bounce in the short term. We're looking for levels that it needs to get back above to bit more optimistic, then that £11 a share level will be the first one to watch. That's from early May. And then you've got that late June low at £11.33. You're not going to make me do Vodafone. Is that really true? It's like a Vodafone show on this place. Oh, actually, I looked at Vodafone and I even thought about the trade of the week, to be fair. So I uttered the immortal words, actually, it looks quite constructive at these levels. So there you go. I feel bad just for saying it, really. But there we go. You see, you like that move higher. It's very, very encouraging. If you just look at, well, let's go to the monthly chart, because I think certain persons in the gallery. There you go. That's like something's causing it to move higher. Technicals only in this. Let's keep the news out of this. No news, please. This is just technicals. This is Axel show. He doesn't believe in news. Very fervent believer in technical analysis. Alutrans. 50-week moving average coming through at 89. So let's see how that fares, because the last time we got up there, 2022, which was a bad year for markets, has to be said, it didn't like it. So let's see what happens the next time it gets back to the 50-week moving average. This time it might not care, but we'll see. But if you're looking at this purely in the short term, nice little pullback from those highs. Some of that euphoria. I wonder who drove that euphoria, but that seems to have come off a bit again. Just looking for a catalyst to move to the upside, back above 84p might be the kind of thing you're looking for. But constructive price action from Vodafone. Perhaps the FTSE 100s after Mondi is perhaps the most boring stock in the index, but there we go. Thank you very much, everybody. Axel will be back next week. You'll all be delighted to hear, or he can comment on how awful the trade of the week has been in his absence. But thank you very much. We'll see you again on Wednesday, though, of course, for Charting Crypto. And don't forget to like and subscribe.
Welcome back to Man vs. Machine, the show where an artificial intelligence LLM goes head-to-head with human intuition and investment experience. I'm Martin, and this is Aaron, and we're here to find out if a multi-billion-dollar LLM can take on good old-fashioned human judgment in building investment portfolios. If you're new to the channel, here are the ground rules. Essentially, each week, we put ourselves in the shoes of a UK retail investor, and we give the free version of ChatGPT 2 simple prompts to analyze and build an investment portfolio. Then Aaron and I take that portfolio and try and optimize it. We're looking to enhance the returns and reduce risks. And last week, we had set the foundations for the AI and the human portfolio. We'd given ChatGPT 2 prompts to create that baseline portfolio. This week, we're looking to take a look at the performance and see how the two portfolios are going so far.
Absolutely. So, as Martin said, there are a few ground rules which we're very much obeying with regards to how we construct the portfolios. So they're on the screen right now. But I think I'm going to actually ask ChatGPT, how have the portfolios done, ChatGPT?
Hey there. The portfolios have done pretty well over the past week. The human managed portfolio had a slight edge, outperforming the AI portfolio by a small margin. Some of the standout performers in the AI portfolio were Nexera Energy and Lockheed Martin, while the human portfolio benefited from strong performance in the tech sector and energy stocks. Overall, both portfolios are off to a solid start.
Absolutely. So you will now see our performance on screen. So we were up 0.56%. AI was up 0.46%. And our benchmark, which is essentially it's a basket of 80% MSCI World equal weight. So all global stocks, but equally weighted, the MSCI World Index, plus 20% cash and ultra short bonds to give it a similar asset allocation to how we've built our portfolios. So we have beaten those benchmarks. Both the human and the AI has done that. But I guess you're all wondering how we managed to do that. So if we look under the bonnet of the portfolios, firstly, let's look at what's driving them. So with regards to the AI portfolio, all sorts of instruments in there. There is certainly a skew towards that sort of cleaner energy theme, that sustainability, but interestingly, a little bit of defense and some big names in some defense and single name stocks. So you've got the likes of BAE Systems, Lockheed Martin, who are playing a role in that. We go into the drivers of this performance. I think what's quite interesting here is you're seeing the likes of BAE Systems, which had a little bit of a bad week, be quite a significant drawdown on the portfolio. Whereas Nexera Energy, really strong week, and Lockheed Martin, which was a beneficiary of the EU trade deal and the expenses towards European Union buying US defense equipment had a really stellar week, whilst equity markets have done quite well over the course of the week, just up around 1%. We go on to our human portfolio now. We can see it's a bit more going on there, very diversified. We tend to go for more of a geographical skew within the portfolios rather than AI going for sort of a world equity exposure. I think interestingly, we've added gold to the portfolio. We've also added Chinese internet tech exposure, which we think is going to be a big beneficiary, and has got an interesting growth story. Whilst we've also gone for the defense trend, but we've done it in a different way. We've gone for a defense ETF with more exposure to the US. And this has actually been really beneficial over the course of the week. If I go on to the next slide, you can see that this defense ETF is up 1.5%, broadly speaking, whilst when I had it on the previous screen, we saw that BAE Systems was down well over 1%. So this just shows that when you're picking single stocks, there is a degree of idiosyncratic or single stock risk, which sometimes having a diversified approach to the theme you can avoid that. Well, I mean, obviously we're pleased with the performance, but I guess let's see how our AI competitor thinks we've done. ChatGPT, do you think Martin and Aaron have done well, and how so?
I think Aaron and Martin have done a great job in curating their portfolio with a nice mix of assets. They included some strong performers like the NASDAQ 100 and S&P 500, which really helped boost their returns. Plus, their combination of regional diversification and a bit of defensive positioning with assets like gold and defense ETFs showed that they put a lot of thought into balancing growth and risk.
Interesting. Yeah, I would agree with that. I think, we've added something which is quite diversified to the portfolio. So we've gone outside of sort of traditional asset classes by having the gold, just outside of traditional equities, as I say, to add that diversification feature, which has been quite useful. Certainly over the course of the year, portfolios has been flat for the week as the performance shows that the gold exposure, but a nice area to add diversification from sort of an active management perspective.
Okay, so we've now looked at the portfolios. We looked at what was driving those portfolios over the last week. We've seen that our performance has slightly beaten the AI portfolio. That being said, that 56 basis points does translate to 29% when annualized, so not too shabby. What I want to do now is take a look at the prompts for rebalancing the portfolio for next week. So first prompt is that we ask ChatGPT again is to provide a comprehensive rundown of current market conditions for a UK investor. It's come up with sort of 3 key areas: central banks and policy direction, risks and equities. Let's dive into those. Aaron, take us through them.
So with monetary policy, it's been on the investors' agenda for, I'd say, probably 3 years. Hikes, cuts, when they're going to come, how quickly they're going to come, and that's still driving the narrative around monetary policy. We obviously saw that, yesterday the US not cut rates. I think it was broadly expected for them to wait till at least August, September, and then probably November time before rates are going to be cut. And ChatGPT has acknowledged that, saying that rate cuts are likely in August and November, and it understands that when you cut rates, it's quite bullish for equities and corporate bonds and risk assets in general. So it's got that ticking along in the background. Risks to monitor as well. Something that we've spoken about extensively is the weakness of the US dollar and also the escalations of potential trade wars. Obviously, we've seen trade tensions fluctuate quite significantly.
Yeah, well, I mean, we're seeing the tariff wars actually simmer down slightly. We've now had this deal reached with the EU, which really puts the favor towards the US. I think we've spoken about it briefly, about how the US, particularly on the defense stock side, emerges as the winner. We saw that with BAE Systems earlier and with Lockheed Martin, and just what separated the two. BAE Systems now building a huge order book. They're up $175 billion in backlog. BAE Systems orders falling 13% actually. So a heavy skew towards US. And this is also on the back of the big, beautiful bill, Donald Trump's major push for fiscal spend in the United States, which already favored the defense stocks. How does that play into things here like inflation shocks that ChatGPT is looking at as a risk?
Well, tariffs have the potential to increase inflation, and I think that's been noted by many different, economists. It's widely noted, and I think that's a concern for many policy makers and investors. Are if we get rising tariffs, or if tariffs come in higher than expected, even though we've seen trade tensions simmer down, what are we going to see inflation figures come to? Because that ultimately drives prompt 1 or the paragraph 1, which is central banks and policy direction. At the moment, we've seen inflation around 2.5% to 3.5% in the US and the UK. Those are the sort of main markets we're looking at the moment. Eurozone, it's come down quite significantly. But I think what's the concern is that in the UK in particular, we've got rising food inflation. We've had a service inflation, which has been lingering around higher levels for way too long. And the Bank of England, are concerned about that. And in the US, we've got also inflation in certain areas, most notably some of the core areas of US inflation still ticking along at slightly higher
and
levels.
I think that weaker US dollar is also going to play into some of that inflation.
Definitely. You get imported inflation, which is economics. You learn that in economics that, if your currency is weaker, it's going to cost you more to bring in goods. So another thing that ChatGPT picked up on was China having a little bit of a slowdown this year. The FTSE underperforming, not year to date, just over the course of the week, because year to date it's actually been really strong, up in excess of 10%. But also it's noted that the FTSE 250 is doing better. So it'll be interesting to see how this bakes into ChatGPT's recommendations for the portfolio.
Okay, so now we're on the second part of the portfolio. We're looking to see if ChatGPT wants to do any rebalancing. And we're not forcing a rebalance, but we're asking it based on the market information that they provided. Do they recommend any changes to the portfolio? This is what they've given us. Do you want to just take us through these?
Yeah, absolutely. And I think what's surprising here is it's made a really big push towards getting rid of clean energy and adding sort of UK names. So it's adding UK dividend ETF, which is likely to be large income generating defensive stocks, which complements the iShares world ETF that it's got in its portfolio, as well as adding gold to the portfolio, which is something we introduced in the first week. And I think it notes that it says here that it's hedging against stagflation, policy shocks, and rate volatility, which we've spoken about. What I find quite surprising, though, is it's very quickly decided to roll back from the clean energy theme, which sort of from an active perspective, one would take a look at a theme such as clean energy and look at it for the longer term. But it's already decided within a week that it wants to roll it back at a few percentage points. So that's something that's quite interesting. So we're going to upload these changes, see how it performs, and then let you know how it performs next week. So thank you very much for tuning in to Man vs. Machine, and we look forward to seeing you next time.
Amazon earnings are out. Apple's up next. It is Thursday, July 31st, 2025. This is Overtime. I'm your host, Chris Vecchio in New York. Ilya Spivak's in San Francisco. No Radigan today. He'll be back with us on Monday. But we're here for now to take you through the futures market close at 5 Eastern, 4 Central. If you're on the platform Tasty Live, nope, that's the website, tastylive.com. The website's Tasty Trade. Either way, welcome to the show. Come over to YouTube. Tell us what you're trading, what you think of this action. As Sunnagoon said, was my bouncy, boyish joyousness yesterday the sign of the top? Maybe indeed. The NASDAQ did rally up here today, only for a little while before it came crashing back in. We have a Microsoft and Meta earnings jubilation overnight, adding more market cap than, say, the entirety of a Costco or a Netflix, as we see, is eradicated, and then some today, where we do ultimately get a move and close below yesterday's low. Ooh, so spooky. An engulfing bar. Key reversal.
at the end of July, heading into the seasonally most bullish time of the year for volatility. Ilya, Microsoft and Meta did make a ton of money, but the market today decides to take some profits. We see a NASDAQ surge to new all-time highs and close below yesterday's low, which is among the worst things that could happen. If you are a bull and have been riding this Icarus into the sun, the wings have, technically speaking, perhaps melted off at this point in time. But we do have Amazon out here after hours. And before, Ilya, we go into this price action for today, I do want to go to the chart. Those earnings are better than expected across the board, which is what makes this reaction, Ilya, as you pointed out, all the more interesting. They beat on EPS, $1.68 versus $1.33 expected. That's a 33% beat. Their revenue is $167.7 billion versus $162 billion expected. Another fantastic beat. The guidance for Q3, the high end was $173 billion. They've guided for $174 to $179 billion. And AWS, which contains their AI efforts, $30.9 billion, 17.5% growth. Ilya, even Amazon here with its strong earnings in the mirror and reasonable growth expectations moving forward, the market is not running with this either, despite bidding it higher all day. We await Apple in a few moments' time, not just yet. But as a bear's bear, as someone tweeted at me today, you were probably feeling really good.
As we were talking about those spikes on the Meta earnings and the Microsoft earnings exactly 24 hours ago now on yesterday's show, my concern with that exuberance was that what happened earlier in the day was the market's displeasure with the Fed, and the exuberance was coming on the back of catalysts that were perhaps short-lived. Those earnings were undeniably impressive, and we didn't learn in them anything that the markets hadn't known. What we learned was perhaps that the forecasts were woefully inadequate, but that was just about it. And what I was concerned about was that the story with the Fed was a bigger story and that we had to be careful before we over-extrapolated a move in absent liquidity before the Asia Open even got underway. And indeed, things held up. They held up in Asia, they held up in Europe for the most part. And then when the US market came in, the price action told you very clearly what they thought. And the whole thing caved in on itself. So this was exactly the thing that I wouldn't say I knew that it was going to happen. Of course I didn't. Nobody could. I was concerned that it might. Because the price action around the Fed and the remaining event risk for the week really did look potent. And of course, the event risk is relevant. So what the markets are telling us here, seemingly, is that good news is unable to impress. And that is more bearish than if the markets were falling on bad news. And that should be a point of concern for risk sentiment all around.
Amazon here, 228 now, right after hours. That action today in the NASDAQ, very brutal. You were asking me what, hopefully I got out of my stuff. Partially, over the course of the day, as I was talking with Nick, it's funny, I sent Nick a message this morning at 10:12 a.m. Eastern time, and I said, this thing is either going to close at all-time highs or we're going to close red today. And that seemed nuts at the time. But the read I was getting on the tape was that you were seeing the Russell fail in certain areas. We can go over to that 15-minute chart just to show.
That thing has been heavy as a rock, obviously, despite the tech earnings where it really couldn't benefit.
10:15 this morning is basically 2240 in the Russell. Why there? Why at that point in time? I would go down to the daily chart, the 4-hour time frame here. And this morning we had broken out of a flag and we were trying to get back into it. So if the Russell of all things could get back into its flag, then surely the NASDAQ and the S&P would be okay. That obviously wasn't the case. So we have a turn lower here, which now potentially we do need to consider, as Tom was suggesting, are the bears in control now? Is this a potential marking for a top? We do have tariffs going into play tomorrow, Ilya.
Maybe, yeah.
Do have non-farm payrolls potentially coming out tomorrow morning. Well, they're definitely coming out tomorrow morning, but that is potentially something that could be a catalyst in this market as well. We're still digesting the Fed. Are we for the stock market at least, are we still in a good news world, or is good news bad news now because the Fed won't have an excuse to cut rates? I'm trying to figure out what the thematic narrative is on that lens after this week. I think we're going to have to think about it for a few more days once we see an FP.
Yeah. I mean, in my mind, it's kind of neither. It's middling data is the worst for risk sentiment. Because I think the markets very clearly are telling you that they want these rate cuts. There's just no question. The markets are also seeing that those rate cuts aren't going to happen near term. I mean, just look at what the pricing is for Fed funds futures for next year. We're out to 83 basis points. The markets see at least 3 cuts, and they're inching closer to 4. What we see from the Fed, obviously, is only a single rate cut that they've forecasted in June. Obviously, take that with a grain of salt. They're probably half-hearted on the 50 basis points that they projected then for this year, if you hear them yesterday. And the market's obviously now hearing that loud and clear. You can see it in the dollar, certainly, where the markets only have 1 cut, maybe, for the remainder of this year. We're out to 29 basis points. That's making now September look unlikely by about a 40-60 spread. 60% chance rates actually don't come down in September.
That was perhaps one of the shocking developments of today's market. Post PCE,
yeah,
we have a market that's saying the odds of a September cut are less likely.
That's right. Well, and with that, the worst thing that seems to stand here in the way of markets is jobs data that's weak enough to keep their desire for rate cuts alive, but strong enough to give the Fed cover to delay. And that's probably the worst of all possible outcomes, and also the likeliest of outcomes. Because if you look at the expectations, we're looking for 110K. That's down from 147. It's slower, but it's not catastrophic. It's not anything that's going to get the Fed to go, oh my God, emergency meeting, or oh my God, we need to sound so dovish from here that there is no question about September. And maybe we'll even go big. You would need a catastrophically weak number. You would need something in the double digits, maybe, with a potent rise in the jobless rate. It's already expected to go up, so that bar is high. It's expected to go up from 4.1 to 4.2. If we spike to 4.3, okay, maybe you might start to stir some hope in the markets. But now, clearly, the market is saying there's a slowdown coming because of the exchange rate in rate cuts from this year going away to rate cuts next year going up by a greater amount. And the markets are very clearly saying here, look, we're not going to be impressed with AI capex. We're not going to be impressed with Amazon earnings. We see a growth risk, and we want these cuts. So if you get a number that lets the Fed off the hook on that, sort of in line with expectations, but doesn't tell you, listen, maybe you don't need rate cuts because the economy is fine, that's the worst of all possible worlds.
We're still waiting on these Apple earnings. As soon as they come out, I will relay them over here, and we'll go over those Apple charts themselves. Ilya, even though the NASDAQ itself had the benefit of those Meta and Microsoft earnings, you would argue that perhaps it would be a little bit weaker here today otherwise. Even so, the Russell is the biggest loser to the downside, and we're starting to get into a place where if support were to be found, this would be a pretty darn good place to find it. In this current environment, if people want to be bullish, how are they structuring their trades? Are they doing this on like a day-to-day basis and kind of just dipping their toes in the water to see what they're doing from pull to pull, 9 a.m. to 4 p.m.? If you're bearish, do you give yourself a little bit more breathing room? How would you approach this? Because I'm thinking about whether or not how my approach has been for the past few weeks is still viable, which is to say that basically buy NASDAQ calls that are at the money, slightly out of the money, call spreads, and then look long S&P 500 puts at the 45-60 DTE window, if only to hedge off some of that risk. Today's action does kind of scare me. It kind of is like the worst possible thing that could happen after Microsoft and Meta earnings.
Yeah. I mean, I think at this point, you have to listen to the price action first and foremost. And what the price action is telling you today is that the market is shrugging off what a month ago would be unmitigated good news. And when you start this from the premise that you began this week with an upside gap after the world's most important growth engines, at least two of them, the US and the EU, finally reached a trade deal and took that uncertainty off the board. This is most of the world's end demand. If China is the middle step and the third engine in this sequence that really hold up global growth, China is the middle of the global supply chain. Europe and the US are end demand. That's the consumption that keeps everything going. And you got a trade deal there. That is an immensely positive development for global growth. And we're down on the week across every major stock index. So that was a tell early. The Meta and the Microsoft earnings being a flop, despite having lifted those stocks. I mean, Meta is up almost 12%. It's not like the market doesn't think the data was good. It's not like the market perceived some sort of a tarnish in the results. No, they were a complete positive as far as the markets were concerned. And that could not hold up overall sentiment. I think at this point, the market is telling you very clearly that there is a tendency here emerging towards some kind of distribution. And so while you don't want to run in front of a market that fundamentally doesn't like going down, the US equity market is generally that way. And I would argue equity markets are that way in general. They're biased. When they do go, they go, because it becomes a fire sale. And so looking at the situation now, I think you look at the Russell, you're directly at support at about 2210 or so. It's probably not attractive to be a seller right here, but you get a breach of this support and you might have an avalanche underneath it. It's a similar story with the S&P, where if you're looking at the September contract, then 63.30, 63.45, something like this, former range resistance turned support, is now very much under fire. You get through that, again, danger. If you look at the NASDAQ, you have what is a very scary looking engulfing candle on the daily chart at this point. And you have very little defense. You have something maybe around 23,000, something else maybe around 22,800, something like this. But at this point, you're very much looking like a top is a live risk. And again, you're near, in the near term, former resistance turned support. So it's probably not the greatest risk reward to lay out aggressive shorts. But if ever there was a time to look at vol sub 20 across all of these things and say, all of them, the NASDAQ is probably the one with the most bearish signaling and the best risk reward relative to immediate support levels. If I'm looking to sort of consider the possibility that maybe sentiment has finally peaked, you can buy put verticals very cheap here. And you could introduce duration into those put verticals that helps to buffer you from near-term volatility and still gives you excellent risk reward if something asymmetric occurs. And ultimately, if you have to let it expire worthless because the stock market doesn't care and powers higher, and you take a loss of 1 to 2% of equity, so be it.
The key development for me is the fact that the NASDAQ lost 23,440 or so. We had the pivot highs here over the past week. We break out, we hold that support. We got the big rally up there. Just for what it's worth, this range 23,100, 23,440. That's 330 points. 330 on top of 440 gives you what, 770. So last night we hit a high of 23,845. The measured move technically completed overnight before we pull back in. Now that we lose 23,440 again, support comes in back at the former swing highs in the short-term basis. You have that low intraday on July 22nd at 23,108. I called it 23,10.
Yeah.
Okay, so we have something.
That's about where I've got it.
We have structurally. That's to work with here for the S&P. It's a similar setup. It probably means you got another 30 or 40 points to the downside, a 0.5% or so before you start to find some support. But the big picture, Ilya, is right now, as we reconstituted a few days ago, if this is indeed the trend that we've been in for the past several months, going back to just around the time that the US and China agreed to a truce in Geneva in May, we've been bumping into the top side of this channel for some time. And this uptrend that we've been in since May, a 3% pullback from here gets you close to 6,200. And then at that point, you'd have been more than 3% off the highs. And you can make the assumption, okay, we now had a 3 to 5% pullback. Is this something I'm interested in buying the dip on? And when you get there, maybe it's mid to late August and you have yourself looking at September. And if you start to break down from there, then you have your September spook, as one usually does. But taking this methodical right now, I think, is the most important thing. Look at how much money some of these tech companies are making. I think the growth scare, though, is the big point. Now, I don't know if it's materializing. I want to just be clear about that, because if you're looking at the data are still very muddled. You can't ignore the fact that third quarter GDP tracking began today, Ilya. And the Atlanta Fed, which, to give them their accolades, their flowers, they had a 2.9% expectation for 2Q.
The Atlanta Fed really nailed it here.
Yeah, the Atlanta Fed was really nailing it. 2.3% is now their third quarter. So they're not saying that okay, second quarter was just an adjustment. Maybe there's still adjustments happening because of government spending and exports, imports, tariffs. But they see underlying growth at least holding up for now still. Mm-hmm. I guess that begs the question. I want to go over to Apple real quick here because I see that we're talking through things. Apple, is this up a little bit? Looks like it's up a touch, actually. That might be nice. Directionally wrong on both, Chris. Good assessment. Apple earnings. Let's see. Maybe not. No, I guess I haven't seen anything.
No.
Just the market getting a little jumpy. Okay, 4 more minutes. Non-farm payrolls tomorrow.
Yes.
Tramal and I were speaking. He thinks that this is going to be a decent enough report. It's not going to bother the market. Tom was a little surprised when he saw that the implied move on ES through the end of the day tomorrow is basically 50 points in either direction. Mm-hmm. That's not necessarily what we've seen going into recent non-farm payroll reports. It's been 27 to 30. Why do you think the market is giving extra weight to tomorrow's report?
Well, let's do just a little bit of sequencing. What have we seen all week? Fed rate cut odds have diminished, and the Fed endorsed that idea for this year. They have likewise grown for next year because the markets want the cuts. They think the cuts are necessary, and they don't appreciate this delay. That they don't appreciate the delay tells you they see some reason that there is concern about growth. And frankly, the second quarter GDP data doesn't do much to dispel that idea, despite the headline number of 3%. Because once you strip out all of those distortions for imports going from surging to nothing, inventories starting to come down and pull down investment numbers, because we're finally starting to spend out of those inventories that were front-loaded in the first quarter. By the way, we're not refilling them at the higher prices. That tells you what wholesalers think about demand. But most importantly, we saw the weakest 6 months of household consumption this year since the first 6 months of 2020, the COVID recession. And that's 68% of the economy. So the markets were validated in thinking, you know what, I think, or we think there's a growth risk here that's mounting. Because that's the part that matters when you take all of the noise out of the equation. So the markets want these cuts. We have since gotten a spate of relatively good corporate news, and the markets plainly don't care, but for episodic jumps, as we just saw, and as we just talked about, Meta, Microsoft, even Amazon. That one couldn't even manage an episodic jump. So when we look at all of this together, we end up with the idea that the markets are thinking macro. They're worried about growth. They want clearance for the Fed to get a move on. And so, of course, a number that speaks directly to the Fed's mandate is going to be of critical importance. This is what they care about. This is what the markets are paying attention to. And if they get a number that's really weak and gives the Fed clearance, I think the markets will embrace that ultimately. They might get spooked at first, but I think anything that gets the Fed out of bed finally is going to be greeted. But if you get a number relatively in line with forecasts that's middling and softer, but not bad as such, the bleeding and the death by 1,000 cuts continues, because the Fed doesn't meet again until September. They would need to start talking very loudly in this direction or that to have any kind of impact at this point, and Jackson Hole is a month away. So at this point, if the number is really, really strong, then the market's growth concerns can get put away, and the market can feel good about saying, you know what, the Fed's waiting, but that's all right. The economy is fine. And if the number is really weak, they can think, oh, good, the cavalry is coming.
I think our Apple earnings may be out, Ilya. Let's just see.
Here we go.
EPS 157 versus 142. A little beat there.
Not bad.
Let's go to the 5-minute chart. Revenue of $94 billion, beating expectations of $88.9 billion. Beat there as well. See the guidance. Lots of individual things here first. Greater China sales, 15.37 billion versus 15.12 billion expected. The net sales overall were 44.58 billion versus 40.22 billion. iPad sales, Mac sales, those all undershot. Wearables, home, and accessory sales also undershot, 7.4 billion versus 7.82. So, I mean, Ilya, maybe there's a story there. People are upgrading their phones before the tariffs came, but then stopped buying everything else. I'm looking for some guidance right now, but share prices are up slightly, 211 here. We closed at 207.57, now in at 211.30. A little bit of a lift for the NASDAQ futures coming out of all of this between our original earnings for Amazon and now Apple trying to find some sort of a low after today's, 400-point move off the high. So tomorrow's non-farm payrolls report. if you're thinking that it's a good news is bad news kind of day then for the stock market. The stock market doesn't want to know it's going sailing for the next 6 weeks until the September 17th Fed meeting without at least someone looking out for them. And by opening the crack a little bit more, are you suggesting that the data's on the softer side? It's not bad yet, but you know what? By the time the Fed gets here, they're going to have to cut. Okay, help's going to be coming. Is that really the best case scenario for stocks?
I think what stocks want here is a tail outcome. They either want something weak enough to wake the Fed, or strong enough to convince them that what the Fed is doing is tolerable. And if they don't get a tail outcome, if what they get is a middling outcome, which unfortunately for risk sentiment is also the likeliest outcome, then we end up with something that helps no one, that inspires no one, that keeps everybody's concerns in place at the same time that it tells them, good for you and your concerns, you're going to have to sit on that maybe past September, because the Fed is just not coming to help you unless there is a flashing red warning sign on the economy somewhere. And so at this point, either the market is shown that the Fed is right to be delaying. And by the way, the Fed doesn't think the Fed is right to be delaying. You heard this from Powell. He said, look, there's real emergence of risks to the jobs market that we see, but we just cannot be cavalier with inflation risk from tariffs until we know more. So either something on growth is bad enough that the Fed is spooked and their risk-reward math changes, or they're going to let the economy wait it out on these inflation risks. And so that's really the biggest issue here, is we're going to have to look at a situation where either the Fed is going to get their motivation or the markets are going to get a respite. But both of those things are tail results.
Once we get through non-farm payrolls, and I'm just going to get some different ticker up here on the screen, Ilya, once we get through non-farm payrolls, what's the most important thing for the market next week?
I think as we look at this next week, obviously there was a absolute flood of data this week for the markets to digest, and they've certainly responded accordingly. We've gotten a lot of volatility. We've gotten a lot of responsiveness. We're going to get a bunch of other sort of not necessarily lesser data points, but sparser data points. We're going to get revisions of S&P PMI data. The ISM services report is coming next week. We haven't even mentioned yet that the manufacturing one is expected to give us the 5th consecutive contraction in manufacturing. That comes out tomorrow. We'll see if that helps. Then we have a Bank of England monetary policy announcement next week. That's interesting for the pound, but maybe not a whole lot else. And then it's pretty much it then, which makes next week actually very interesting. I should, by the way, point out, we also have Eurozone inflation data that's coming out over the next 24 hours that might have some delayed digestion, but again, relevant for the euro, maybe not much else. And then next week, Chinese import-export data also. That's a good input into overall global growth considerations. But in general, it's a little bit sparser next week than it was this week. And I think what that gives the markets, interestingly, is some room to digest all of what they've seen. And we're seeing the price action rebel against the news flow here already, at least as far as corporate earnings are concerned. And we see the markets look at economic data that they've seen and go, you know what, we're going to see the grain of salt in this. We're not going to attempt to justify a positive view. We're going to attempt to justify a negative view. We're going to elevate one kind of a thing within the data, because the data is, as ever, open to interpretation depending on what you wish to see. And we're going to emphasize this downside risk. You see it in the growing rate cut expectations. You see it in the unwillingness to rally on earnings, et cetera, et cetera. And so when you look at all of that together, you kind of get a sense for the path of least resistance that's starting to emerge. And without the benefit of big headlines next week, or at least sparser big headlines next week, the markets may be left to their own devices for more of what happens next week. And if this is the path of least resistance that's emerging, then that's not happy news.
How seriously should we be taking the tariff deadline tonight? Because it seems like that's also ignored, not discussed today. I mean, I've been following financial media all day. People have been talking about the tariff deadline as, well, we already have things sorted with Japan, South Korea, Europe, so who cares?
And we've already apparently pushed the can down the road with China, which is another big one. And
Mexico.
And Mexico. I suppose the biggest concern here might be the situation with Canada, but ultimately Canada is not a big enough economy to really sort of spook things to the extent that something like a Japan or certainly the EU, certainly China might have, were that to be a rupture. I think very interestingly, we saw that the president made some really interesting exemptions from his copper tariffs, and copper crashed. And then the president imposed 50% tariffs on Brazil, and those markets rallied. So I think the market is maybe starting to kind of discount all of this to focus on the macro and to basically say, okay, well, yeah, there's a deadline. There's a bunch of countries that are going to get letters. Those letters will probably say that the tariffs are going to be whatever they are. 15% looks like it's emerging as the new baseline. But these are not the kind of huge economies that everybody is going to have a terrible amount of concern about impacting the global macro pie as a whole. And so it is an important deadline, and of course has tremendous potential to surprise, but it doesn't seem like this is going to be a Liberation Day type shock.
Liberation Day like shock. No, I don't think it's going to be either. Although I'm the guy who said that Apple was going to be down and Amazon would be up here after earnings. So what do I know?
But look at Apple on even a 4-hour chart, and it hasn't really gone anywhere.
Yeah, what's a 1% move between friends? So I find it very difficult to think that tariffs this time around are going to impact if they get into place. Directionally, when we're going here in April, it's more of the ratcheting up in tariff world. You know, you look at Trump funny, he gives you another tariff kind of situation.
Yeah.
And every day was we're one step closer to the edge and he's threatening us more. And then here come the tariffs and it was escalating. There's no off ramp. We're not looking at the market. You know, Wall Street's had the past 20 years. It's now Main Street's turn. We had all those cliche things.
Yeah.
And the rhetoric this time is, yeah, the tariff's going to be around 15%. I'm sure we're going to work out a deal. Don't worry about it. It's much softer directionally. So when they do go into place, it's like, yeah, they're going to go into place, but we're still going to talk. I don't know how much juice there is for that because it's still the market's condition that, well, absent materially negative economic impact or deterioration of corporate earnings, then this is something that we probably could just take in stride. So I don't know if we get the tariffs in play tomorrow and then you have a Monday market open with the NASDAQ's -2 because we couldn't solve our trade situation with, you know, Ecuador and, you know, New Guinea, for example.
Right.
Everyone else is a different story. But the encouraging signs for today's market, longer term, the dollar is still very much in the catbird seat here, Ilya. It is extending its gains versus the pound. It's extending its gains versus the euro. The Japanese yen has finally collapsed. Thank God.
No, the BOJ certainly did not help the yen overnight. Governor Ueda came out very, very dovish. Even, by the way, relative to forecast that the BOJ issued, because initially the BOJ made the announcement, they increased their inflation expectations, and the yen actually rallied. And then Governor Ueda came out and said, okay, no. You got to go the other way. Thank you very much. And the yen has since cratered.
Well, Japan's in a really interesting situation because the primary driver of their inflation right now are rice prices.
Yes.
And if you were to say in a normal situation, Japan just import more rice. But they don't want to do that because rice is considered a national staple. It's a point of pride culturally. And they want to have the high prices incentivize more domestic production. So if the BOJ were to hike rates in response to not enough rice supply, would that help incentivize or disincentivize new rice production? It might make access to credit more difficult to come by, thereby making it more difficult to grow more rice. So you have this unfortunate situation now where real Japanese rates are effectively falling out because inflation's going up and the BOJ is saying, yeah, we can't push up nominal rates to match them. So bad for the currency, a currency that obviously still has a very crowded position here, Ilya. The euro, the yen, the pound, all very crowded. How far can the dollar go? Is this a tactical bounce or should traders start thinking about something more? We've gone from the low 96s or mid 96s, I should say, up towards 100 now over the course of July. It's a nice, greater than a little bit more than a 4% move, but we have not yet seen a path back to 110. How does the dollar fare in the month of August from your particular perspective?
In my mind, we're in the midst of a dollar recovery that isn't done. I think a lot of what we saw in the first half of the year had to do with sort of structural reasons. Obviously, the Fed has only delayed rate cuts, and the dollar nevertheless had its worst 6 months, perhaps on record. And so when we look at sort of what's behind that, it's not difficult to start to imagine that we had a serious spook vis-a-vis the tariffs. At first, it became a spook about we're going to have less global commerce. And of course, if global commerce is fundamentally transacted in dollars, then less global commerce means less use of dollars. This is not shocking. And so what you end up seeing is first a slow decline, then a faster one, and then a slower one again. While stocks rebounded from April's pain points, the dollar very clearly did not. It just went back to slow decline mode. And that's because the faster decline was about, oh my God, we might see the US purposefully crash its own global financial order. But once it became clear that, in fact, the administration does have some amount of market discipline, does respond when the bond market gets quote unquote yippy, we can go back to a slower decline whereby we're not going to crash the car. We're just going to slow the car a lot. And so we're back by the middle of the year to this idea that we're going to have less global use for its primary commercial currency. That story seems to be all in the market at this point as these tariff plans get cemented. And now we get back to currency brass tacks. The US, with the Fed delay, has the highest yielding currency of the majors, in some places by a fairly significant margin. And so, and with for example, the Eurozone inflation data this week. We've seen Germany already. We'll see the region as a whole overnight. The sense is that they're not exactly rate hikers next year, despite the fact that they're probably almost done cutting. So we're probably getting back to a dollar that has significant room to recover now because it has yield advantage, and the risks to its sort of structural underpinnings seem to be fading. I think there's more to go here. I'm probably very long now. I've gotten short the Canadian dollar now. I've upped the bet on the Australian dollar, and at this point, that's in my mind the path of least resistance until further notice.
Ilya, it was just you and me today for overtime. We were fortunate that we were able to get Yumi and Radigan together yesterday on the show. So we're going to wind this up a little bit early so you can catch your breath and get ready for your next Macro Money segment. Non-farm payrolls are tomorrow morning, 8:30 a.m. Eastern, 7:30 Central Time. ISM manufacturing will be 10 a.m. Eastern, 9 a.m. Central Time. We've gotten through what's been a very busy 2 days so far. It's acronym week, earnings week here. GDP, FOMC, now NFPs due up. Ilya, you're going to be back in a few minutes' time. Get some water, folks. Get a quick rest. We'll see everyone on the other side of a quick break. You're watching Tasty Live.
Everybody, and welcome back to Risk and Reward of the Week. Today's Thursday, close to the end of the week. It's been pretty volatile. We're going to get into some hot topics of today to get your guys' thoughts on it. But how we doing so far into the week, Gus?
Yeah,
some hot topics.
Doing well. Yeah, hot topics for sure. We were just having a highly inappropriate conversation that Errol took right up to the to the buzzer here. But yeah, no, doing good. It's been a horrendous week for me in the market, I must say. You kind of hit the nail right on the head talking about with your risk of the week with SPY with 5 straight green weeks. We were due for a little bit of a week of breathing. We just closed our 3rd straight red day today, and that comes after Meta and Microsoft both blew earnings out of the water this morning. Yeah, not even that was enough to prop up the S&P for the day. So yeah, it's we finally got a little bit of chop, and it's not even really like a breathing period or like this considerable downturn. It's just like we finally aren't going up every single day anymore.
We had a really large move after the bell yesterday. We gave a lot of that move back today. I mean, it always feels like the sell-offs feel a lot more aggressive and a lot more intense than the moves to the upside do. So excited to get into that today. As for the market, I mean, I do have a few positions on. I was short on one of the earnings for Meta yesterday, and I mean, they blew it absolutely out of the water. So still got the UAL position on. That one was from earnings, and I'm still sitting break even on that. So we'll get into all the details there. But it is Thursday. We do have some topics to talk about. And you heard about any of the Sydney Sweeney topic buzz drama going on right now?
Yes, who hasn't heard about the Sydney Sweeney, all this buzz going on right now? It's this really interesting amalgamous thing that has some people very upset, has other people celebrating for a whole variety of reasons. And yeah, we're gonna dive in and talk some Sydney Sweeney. If you guys aren't familiar, I'm a big Sydney Sweeney fan myself. For her acting ability.
Of course.
I just think that she's a wonderful actress.
Absolutely.
That's it. There's no other reason. No ulterior motives here.
Absolutely.
I think she does great work in commercials. I think the Dr. Squatch commercial where they put her bathwater in the soaps, I think that was funny.
You know, it's
a good marketing campaign.
It was good It sounds so outrageous, but I think that's what marketing is at the same time. Good marketing that pierces through the noise, but at the same time, the bathwater. Can you give us a little bit, real quick, as we get into it? And I think it's funny because I think it's culturally relevant. Give us a little insight on what was that bathwater in the marketing for Sydney Sweeney, those kind of things.
Sure. Let's go even broader. Okay. Sydney Sweeney, if you're not familiar with her, she is a very successful actress right now. Perhaps, probably a top 10 most successful actress that's out in the world right now. She came up, she's been acting since she was young. She came up on Disney Channel and then jumped over to, did we decide it was Riverdale? No, it's Euphoria.
It was Euphoria.
Yes, got her first big adult role on Euphoria.
That's when I initially found out.
Yes, and that is when she initially shot into relevance was through her role on Euphoria. She's done a number of movies since. She just, I know she had a big rom-com that did really well last year. And she is very attractive. So lots of companies have, I guess, gotten her for marketing campaigns to lean into the fact that she is very attractive. And one of them was Dr. Squatch, which is a soap company. They make soaps that they say are natural. I actually used Dr. Squatch soap for a little while I was in high school, but it really dried me out. So that's my personal take. But I got eczema and stuff, so I kind of need, I got a dermatologist recommended soap now. But she did a marketing campaign for Dr. Squatch soap where they were taking her bath water and putting it into bars of soap. And that was the entire marketing campaign. Low-hanging fruit for sure, but also, as Errol alluded to, in this day and age with marketing and with everybody having the ability to market on social media freely and however they see fit, you kind of do have to do something to be able to cut through all that noise and get people buzzing about you. And companies seem to be finding that Sydney Sweeney is a good way to do that.
100%. And I think with the bathwater, I wanted to bring it up. The fact that it was culturally relevant. And don't worry, guys, we're gonna tie this into what does this have to do with the market. We'll talk a little bit
this
about
has strong market
American
ties,
Eagle
people.
stock.
Just bear with us.
But I do think it's really culturally relevant just because, what's funny? The bathwater is so outrageous just to even think about. They know that. That's why these headlines are going to be buzzing. The bathwater came from TikTok comments. If nobody else knows that, right? If you're a Gen Z and you're reading up in those comments, that was a joke initially.
Oh, yeah. Like, let me drink your bathwater.
Right, absolutely.
I would do X, Y, Z just to be able to. Yeah.
Right.
Exactly.
So this is where it came from, just to add a little bit of context. Because if you think about it.
Simping is a new phenomenon as well. Yes, correct.
So with the whole bathwater thing, it might sound like it came out of nowhere, but it was actually really culturally relevant, especially if you're a younger individual on TikTok looking at the comments section. So.
Yes. And I do think credit where it's due. I think Belle Delphine invented the bathwater thing. I think she was the first one.
Was it?
I think she was the first one that was ever out here selling bathwater. So shout out to her. But again, I think that was created from the prominence of that sort of commentary.
Yeah.
Yes. So selling bathwater. Guys, don't buy bathwater. Don't buy bathwater. Don't buy cans of farts. Don't do any of these things. Don't, please.
And if you do, just take it to the grave.
If you're ever thinking about it, think about me and don't do it for me. I'm asking you personally. But let's dive right in here. Sydney Sweeney has great genes. Sydney Sweeney made headlines this week following a raunchy ad campaign with American Eagle. But is the outrage justified? And more importantly, what impact did this have on the market? That's a big one, a way bigger one than you would think from an ad campaign. So let's dive right in here. So first and foremost, the ad itself. Sydney Sweeney is running an ad campaign with American Eagle right now, and the tagline for this entire campaign is "Sydney Sweeney has great genes," and they spell jeans with a J. American Eagle sells jeans. That's
off the bat. When I saw that, I was like, "Oh, it's fire marketing." I was like, "That's a bar," and that was my initial reaction before reading any comments, anything like that. I was like, "Wow." Give that intern a raise.
Yes, exactly. Whoever came up with this, I absolutely agree. American Eagle, obviously, jeans are one of their primary products. Sydney Sweeney, an incredibly attractive woman, obviously has good genes with a G. This is a fun little tie-in that came about. But they took a raunchy angle. They leaned into her sex appeal, which is something that she has, expressed that she's comfortable with. And more power to her, by the way. I will say, I said to Errol earlier off air, if I were Sydney Sweeney, I would be doing the exact same thing. I can't imagine how much money they paid her for this. Yeah, exactly. So here's a few screenshots from the ad campaign itself. There is many, many more. I was able to source like 8 or 9 different cuts that they did of this ad earlier this morning. But these 3 screenshots along the top are from what's going to be our specific advertisement.
So it was like frame by frame.
That's going to be our specific advertisement of interest for the day. This is the one that has created a lot of outrage, and it has not, and this is important to emphasize, it has not created much outrage because she is leaning into her sex appeal.
Right.
People rather are upset about the jeans comment,
right,
which is the bigger issue. So kick us over here. Tell us about the backlash, Errol.
We got a little bit of backlash. If you were on Twitter today at some point, as we've seen in the comment section right here, you did see Tom in a very similar outfit. Don't be alarmed. But as we get into a couple of these tweets, this is where a lot of the criticisms really came from. Over here we have it comparing it to, the sex workers a little bit. Sex workers equals heroes and Sydney Sweeney. So hard to see the comments on that one. But you can see a lot of the backlash from Sydney Sweeney sexualizing herself. And you made a comment that I want to piggyback a little bit off of earlier today, was the fact that, times have changed. It is 2025. I think we have to take into account what the younger generation is a little bit more comfortable, what's a little bit more socially acceptable. On that topic, I think it is a little bit more supported. So I think it is a little bit hypocritical to push back on the sexualized angle that people are taking the criticism from on Sydney Sweeney, because at the same time, the younger generation, or at least our culture, we support that a little bit more. So it does kind of seem like a cultural hypocrisy at the same time. So that was my initial take from some of these screenshots and criticisms that we see.
Yeah, that's absolutely something. And it's like, it's this initial reply from this Volo individual on Twitter here. Does Sydney Sweeney do anything besides sexualize herself? And it's like, yeah, if you want to take the stance of women should not sexualize themselves for profit, I can absolutely respect that, but you better hold that stance across the board.
Absolutely.
Like what I was saying to you earlier today is you can't say this about Sydney Sweeney, and then when one of your girlfriends says that they want to start an OnlyFans, say, oh, yes, queen, do that. Get your bag. You have to pick one lane or the other. And as long as you're consistent in it, I can respect whatever your viewpoint is. But yes, this Jack Mack individual then draws great attention to the point that is sort of a hypocritical stance to take, especially in the modern age. So yeah, that's the sex appeal side of it. Let's dive over into the, I don't know. I don't want to use the word woke.
More backlash.
Yes, but the heavier backlash side of it.
Yeah.
Many people were very, very upset about the genes part of this and insinuated that because Sydney Sweeney is a white woman with blonde hair and blue eyes, that this somehow was Nazi symbolism or has Nazi undertones. Now, I don't get political on this show ever, and I don't think this is a political comment that I'm about to make. I think that is ridiculous. And specifically, the specific quote is, she said, I have great genes and my genes are blue.
Right.
And then people are taking that and interpreting it as she's talking about her eye color, eugenics is mentioned, dog whistles, all these buzzwords that people like to use these days. But it's just not that. Like, this just feels like as we said at the beginning, it just feels like a good campaign to me.
I've been offended at things before. And typically, if I'm ever offended at something, if I'm honest with myself, at its core, it's rooted in insecurity. Right. So I think that whenever we see takes like that online, it could be, if we crank the data, it could be rooted in a little bit of insecurity. And that could just be like the initial reaction. Completely agree.
Yes.
Right.
And I would be inclined to agree with that viewpoint, especially as it pertains to her sexualizing.
Right, absolutely. Yeah.
Yes.
Yeah,
because
100%.
she is obviously incredibly attractive and perhaps insecurity plays into that. And I think that it could absolutely be true here as well. I'm seeing engineered outrage in the chat. I think that's
it's like human behavior.
Vernacular.
Humans react to certain things. Another attractive woman, it could cause a little bit, depending on how we market her. Also, with the bath soap, I think she also realized, or their marketing team, her whole team probably recognized her name was catching so much buzz. The bath soap was the first thing, right? And American Eagle and some other ads came after that. So I think they noticed that, wow, this towing the line with our marketing is working really well. And we ended up seeing a breakout with that American Eagle ad.
Absolutely, yes. As we're about to get into here in a second. And,
oh, right.
And I mean, no big deal. And the point is, though, that we are sitting here talking about this right now. I mean, that means that this is a good advertisement. It gets people talking. It creates brand awareness. I don't know when the last time I even thought about American Eagle was. And actually, I know.
True.
I can tell you the last time I thought about American Eagle, and it's when they signed Addison Rae in like 2021. So American Eagle doing good things, with their marketing. But anyway, let's we can dive over here and let's talk about the impacts of this.
We got a little bit of impacts on the American Eagle. Shares surged 23.3% from $9.65 to $12.20 after the new ad campaign that sparked a lot of outrage. Shares have since settled around $11. It's a pretty cheap underlying, not too expensive, but it still reflects about a 14% gain driven purely by this campaign that we've been seeing. No reported sales boost or change in fundamentals. So purely, we don't always know exactly what moves a stock. We don't exactly know why people are buying and selling, but with no fundamental changes or no new news for American Eagle besides their campaigns, I think we can credit this recent volatility towards what's been going on with Sydney Sweeney.
Yes, absolutely. And it's insane that this kind of move can even happen. Even if American Eagle gives all of these gains back and they wind up just settling back in at their share price, which logically they should do. Nothing has changed about the fundamentals of the company surrounding this until we see more sales numbers or something like that. But the fact that a single ad campaign can have this type of impact, can swing you up almost 25% in the stock market, is insanity. And it's purely because of the ad.
Yeah.
So yeah, moving forward, is this brilliant? Starts to become the question. American Eagle shares are currently sitting up 14%. Searches here, that's this top blue line Google Trends bar here. Searches are up 500% for American Eagle in the last, in the last month, I should say, rolling month. This collab, it trended for 2 days on Twitter, X, it was everywhere. And yeah, ultimately the controversy has just boosted the brand of both people. There's a ton of buzz everywhere, including right now as we're sitting here for Sydney Sweeney, for American Eagle. Search results are way through the roof. Obviously, brand awareness has increased and you tangibly increased your market cap. I mean, what more can you ask for out of an advertisement? That's more than you usually can ask for out of an advertisement.
100%. I mean, it kind of sounds like we're going back to some of the marketing that is really towing the line. I think that gets a lot of engagement, that gets a lot of traction. I think really what it comes down to at the end of the day, to just based off of pure personal speculation, is I think marketing teams are getting with the times. I think that's really what it comes down to. I think marketing teams are learning social media a little bit better. I think all or of most marketing teams are recognizing that to be competitive, you have to be on social media in some capacity. So I think we're kind of seeing a change in just the marketing culture, because I think it's like the Titanic. It's like a big moving ship. It's like it goes from the TV running ads. Now it's like these companies don't even have budgets to give companies that are looking to be on TV anymore. Now it's switching to social media. And now a lot of these people are getting the budgets for that. So I think what it really comes down to is just a shift in a lot of the marketing culture.
Absolutely. And I think there's also a major factor of, knowing your clientele. And obviously you would never want to do any advertising that alienates your clientele. That goes without saying. But beyond that, yeah, American Eagle recognizes that their clientele, the people that they're trying to appeal to, are culturally aware of Sydney Sweeney, are primarily on social media. Right. And I think that Sydney Sweeney's management team is starting to realize that they kind of have a modern day Marilyn Monroe sitting here, and they're taking their opportunities to leverage that. I don't think it's a shortcoming on the
Or do you think, I just thought about this, you think they missed their target audience and it blew up even more? Perhaps. Or maybe their target audience help prop up the attention, and then it garnered more attention. I don't know, but it's something to think about.
I mean, fundamentally, I think that modeling with clothing companies, and regardless of gender, both ways, has always been about showing attractive people wearing your clothes and trying to insinuate to us, the viewer of the ad, that, oh, you can look like this too if you wear our clothes. And so I think that they haven't really changed the model all that much. They just decided to be way more direct about it.
Right.
And
Great point.
I think that that's
Great
an interesting angle to take.
Yeah.
But yeah, that's what we got on the slides for Sydney Sweeney.
No, yeah, we'll check it out. American Eagle's a lot cheaper underlying than I would have expected. It's not something I was personally trading. But
Yeah, American Eagle and Abercrombie, those are the middle school, high school staples.
Yo, wait, Abercrombie, I feel, has gotten a lot more popular in like the last 3 years.
You think?
I think so, unless I just wasn't with the time. Like, I don't recognize I haven't been with the times in certain regards until I hang out with my brother. To be honest. Like, Joe, you know T.
Sure.
Yeah. But no, I digress.
Yeah. Well, yeah. It's like having Thomas out there. Like Thomas,
Right.
he makes me.
It's
feel
like
old.
little
I know you're
things.
watching, Thomas.
Right,
We
yeah,
love you.
yeah.
But yeah, these little like nuanced things. It's like
It used to be like, that was me. That was me. I don't know how I missed that. That was me.
It's funny. I guess we're just having a conversation about aging in general here now, but it's funny because I always kind of had this idea, like in high school and in college, when I would say I was still with the times or whatever, and I think I still very much am. To
All right, old man, calm down.
Yeah, exactly. This guy's born in the 1900s trying to talk shit to me. But I think that I always had this idea that, all these ideas are exchanged on social media, and I have no, ideas about leaving social media anytime soon. So I will probably stay with the times. But what I did not account for is that my interests and the people that I follow and what the algorithm feeds me on social media will change. And suddenly these, the things that are being created from shit posts just don't appear anymore.
So there's one of my favorite quotes is the fact that the stock market is a direct reflection of yourself. And I feel like we could say your algorithm is I don't know, maybe that's a reach. Your algorithm is a direct reflection.
I mean, it is
a little bit.
It's supposed to be.
It's supposed to be, at least. We do just have a few more minutes left here. Anything else to add on the comments with Sydney Sweeney, American Eagle? Anything else you got on your mind heading into the end of the week, Gus?
I think that there's a lot of people who wake up every day and go out into the world and look for things to be offended about. And
True.
I think that is a sad way to live life. And I think, if you are one of these people who is offended about this, I beg of you, go outside.
Yes.
Please. Go outside, experience the world. People are actually pretty chill across the board.
So one thing that I have noticed is in my 50 years of life is typically when others
you're like 10% older than me. Give me some sage advice.
Well, I've noticed typically when others are acting or have actions that kind of spill onto you a little bit, or someone is maybe lacking some self-awareness here and here, typically they're going through something on their own. Like typically whatever it might be, and then it's just spilling onto you. And I think a lot of the times then we'll latch on to a lot of these things that help us feel in the current state that we feel. Oh, negativity. I feel that, so I can latch on here. I can chew you out. I can do this because I'm in that state. So a lot of the times I've also recognized that. So I think it's just a check. Like if you recognize you're scrolling on social media and you're getting offended and like it's working you up, just take a quick moment and pause and be like, yo, this isn't a way to live life, first of all. And then second of all, it's a key to look inward. So I'm gonna leave it with that.
Yeah, absolutely.
Because I find myself getting riled up sometimes about stuff I see.
Oh yeah, absolutely,
online, and I'll be
absolutely.
Like, whoa.
Oh yeah, and
I laugh at
absolutely
myself
something that's come with maturity as well. I mean, when I was like 15, 16, 17, I was fighting with people in Instagram comment sections on the daily about whatever. You say something I agree with.
And you can articulate yourself really well too. So you were probably giving them a field day.
I'd give you the business. I'd break out like the specific fallacy that you're committing and all this. And at a point, I just realized that all these, it's not real. Why would I waste my time and stress myself out and get myself worked up about these things that are online? In reality, if you actually go out into the world and walk around, it ain't that bad. Everyone's very nice to each other at large. And I would further add that, there's an old adage that I still think is absolutely true in a person to person context that you're the average of the 5 people around you. But what I think that people haven't accounted for as we've moved into this age of social media is that those 5 people around you might not actually be the people in your life, or that all of your social media following or whoever's validating you in these comment sections or fighting back at you, that can also, those play in.
You find community outside of real world. Absolutely.
Yes, absolutely. So I think that it's just important to always consider who you're surrounding yourself with, and that extends beyond just who you actually physically see or talk to on a day-to-day basis.
I see here. I'm gonna have to do more research on the Sydney Sweeney woman. Our segment worked for today.
Grey Poupon mustard. I know about Grey Poupon. There's a commercial. Oh man, Dad, if you're watching, I'm so sorry. He would quote this commercial all the time. It's like, do you have any Grey Poupon? I think that's what it is. Can somebody fact check me on that? I think that's how they advertised. But yeah, that's a big thing.
I'm not a big fan of mustard. I just can't.
I was made to.
That's one thing I've never got around to.
I never really. I don't know. Mustard. It's actually just like last year. I've kind of started liking mustard a little bit. Yeah.
Dang.
When I was in Yellowstone National Park last weekend, for the first time in my life, put mustard on something.
Wow.
I got a burger.
And you enjoyed it?
Yeah. I enjoyed it. Got a burger. I was like, oh, this is it's missing a little something. That mustard was staring at me like a goblin mask.
I don't believe it. Well, that's going to wrap it up for today's segment. Tomorrow's Friday. Anything else to add before we hop on out of here?
No, nothing. Cool. This was a great discussion.
That's going to wrap it up, guys. Thanks for taking the time to hang out with us. Be sure to stay tuned for more segments coming on next. We'll catch you guys next time. Peace.
Day night. I'm Tom Sosnoff, and I'm here with, this is First Call. I'm here with Chris Vecchio, Ilya Spivak's in the green room right now, and we're ready to talk markets for the next 35, 40 minutes. We'll see what's going on. Chris, you ready for a Sunday night opening? Uh-oh.
Ready for a Sunday night opening? It looks like the market's going to be flat.
Yeah, flat to down, maybe down a hair on the opening. We're very excited here in Chicago. Justin Turner just hit a walk-off about 5 minutes ago, so Cubs win. And I know you don't care, but I live in Wrigleyville, so I have to care. But I think they're going to actually, it looks like NASDAQ's probably going to be down about 20 handles, and the S&P's maybe down about 10, which would put them kind of back near where they were trading just a couple of minutes before the close on Friday. We were down, about 100, let's just say 107 to 110 handles on Friday. So you're talking about, that's the biggest down move we've had in a while, almost 2%, or, 1.5 to 1 3/4. That's a pretty big down move for us.
It's a big down move. We're coming into the fun part of the year, Tom. Seasonality says that volatility starts to rise here. Also, the market was just so overstretched. So stretched, 90th percentile, 93rd percentile for CTA positioning. Maybe it was just time for a pullback. I know a lot of people were looking for a market that was, a little too frothy last week, and perhaps this is going to be day 3, Mr. Sosnoff.
Well, let's be fair here. We've been going up pretty much straight up. I don't think we've had 3 consecutive down days since the April lows, or maybe there was one time, but we haven't had, a couple of days like we've had the last couple of days. We haven't had any really down move since the beginning of April. Last couple of days, we got a little bit soft. There was a lot of weird stuff that happened, earnings wise, it figures earnings were all good for Friday morning and the market gets killed. And then there was just a lot of other kinds of shenanigans. And whenever you start to see that stuff happening, I don't know, it's kind of got to get you a little bit nervous. I would think. I mean, forget about valuations in general. Just the market's just, the eye test would tell you the market's stretched. I think a couple of weeks ago, Chris, you and I said on the show on a Sunday night, we're like, show me 10 stocks you think are undervalued. Just eye test. Forget about, I don't care about the fundamentals or technicals or anything like that. Just show me 10 but show me 100 that you think are overvalued. And whenever you get that way, I mean, we're usually right. We're usually early. We're usually right.
You mentioned that earnings have been coming out good. I think this is a really important dichotomy to understand about the market psychology right now. We've had about 2/3 of companies report earnings so far for the second quarter. 82% have been beating their estimate, which is above the 5-year average and the 10-year average of 78% and 75% respectively. But this is really the issue. If you're missing, you're getting absolutely crushed right now by the market. The scorecard is horribly lopsided in one direction. Winners, losers, terrible here. The numbers that I have from FactSet, Tom, if you are a company right now that is, and it just slipped off my screen, of course, while I'm saying this. If you are a company that's missing right now, you are losing about 5.6% in the 2-day window before and 2-day window afterwards from your earnings miss. That's way bigger than the 2.4% average loss that companies are seeing over the past 5 years during that same window.
Yeah.
Winners, right? You're only seeing a 0.9% increase. Typically, it's about a 1. So winners not being rewarded as much, losers really being walloped right now. Price for perfection, right? Price for perfection.
I have another theory on this. These companies have gotten really good at lowballing expectations. Companies have just become very skilled. They used to be, they used to not have as much emphasis on earnings, so that earnings were just kind of like, listen, when CFOs would be like, just push out the numbers, they are what they are, and we'll give whatever guidance we have to. But companies have become very good, and CFOs have become very good at lowering expectations because CEOs want to look good and they want to beat on the next quarter. So I wouldn't put that much faith in those, we always are significantly more outperformed to the upside than miss. So I don't think that's really the key. Here we just opened, and it's kind of just what we said. S&P's down 5 or 6. They're all over the place right now. Now they're down 4 or 3. But S&P's open, well, right now they're down 3, and Nasdaq's down 10. It opened down 20. Russell opened up a couple pennies, and bonds, after a huge rally right into the close, they are down 3 ticks at 115.18. Bitcoin opened up, gold opened up $20, silver opened up 16 cents. The euro opened a little higher today after an explosive move on Friday. The yen opened a little bit higher, and so actually S&Ps now are unchanged. And the Nasdaq's only down 7, so it's kind of like let's call it a flat opening. But what's interesting is that for the first time in a long time, I started to read a lot of stuff over the weekend that was basically just talking about a couple different things. And I thought I'd bring them up with you. One was that discussion I just said, where CFOs and companies have gotten really good at lowering expectations, so it looks like it's an earning beat, but in reality, it's not. Like, I think Apple did that this time. At first glance, it looked like, oh, this is a good number. And then when everybody, broke it down on Friday, the stock ended up down $5. Amazon, I think they thought they had a pretty decent number, and the stock was down, $19 for the day. I think Coinbase thought, based on what they pushed out, it looked like they were kind of like expecting, maybe we're down $5-10, but our numbers are pretty good. Stock was down 60. I thought that all these digital asset companies, they've been so outrageously priced. If you want to talk about price to perfection, MicroStrategies, Robinhood, Coinbase, those companies have been truly priced to perfection, and those are the ones that kind of took the biggest. I feel like they took the biggest hit. But you know what? I like it when we have some big hits because it gives us a chance to, maybe a little two-sided trade here.
Yeah, it's interesting that you say that about Amazon missing. I saw some people this week quipping about some of the tech earnings where the depreciated cost of the servers and GPUs that they're using is basically extended over 10 years when you look at their income statements. When in reality, for a company like Meta, they're turning over their GPUs every 2 years because the technology just keeps improving. So they have to get the new ones. And so this isn't my sense, but I do see enough people out there talking from like the financial reporting and analysis perspective. Like it seems like the CFOs have done everything they can to paint the tape and the window dress to make the earnings look as good as possible. Going forward, though, it's a different story. Companies are being decidedly more conservative. And, what else do we have this week that can carry the flag of this market, Tom? I'm looking at the earnings calendar here. Palantir on Monday, AMD Tuesday, Wednesday, McDonald's and Disney, Uber. Thursday, Eli Lilly, Friday, Lamar Advertising Company. So this doesn't feel like it was last week.
No, and nobody really cares about Disney and McDonald's. Those won't move those won't move anything. Nobody cares what the Dow does based on those stocks. Yeah, the S&Ps are trading thin tonight. They were just down 12. I mean, they were up 50 cents, then they were down 12 a second ago. Now they're down 6. So they've been very, very thin, very choppy tonight, very thin. This is clearly a market that's trying to decide how much follow through there's going to be from Friday. I do not think it's early enough to even consider nibbling here. I mean, that down.
Neither do I.
Yeah, I mean, 62.50 from what are we off the highs? A little less than 200. 200 S&P points. That's less than 3%. That's not an entry point for me. Like, I don't know what you think a reasonable sell-off in the market is. But if it's not somewhere between 5 and 10 and at least 10% for me, if I'm going to buy anything, then, I just consider it just two-sided choppy trade. So we're nowhere close to a point where I think anything is remotely oversold.
No, and with Friday and the pullback, I mean, I will admit I mishandled some of my equity longs last week that I was trading in and out of. I was riding high.
Everybody did.
I covered part of my position on Friday, and then I had these 0 DTEs on Friday that were deep in the money and then expired absolutely worthless. And so on Thursday, at the end of the month. And so coming into Friday, just given the seasonality, I've never really had a good run in recent years, personally, being long stocks in August and September. Getting long stocks in October has worked out swimmingly well for myself. So I've just been a little bit more apprehensive. I had no equity long deltas on Friday coming into non-farm payrolls. And now I'm looking at this market, and could it bounce from here? I see it a place on my screen, both on the NASDAQ and the S&P, where maybe. But if we're not holding here, why not get a flush back below 22K, 2150? Or 21,500, the NASDAQ. Why not back down to like 6,000 or so in ES? Give us another 3%. That would be a 5 to 7% move off the highs in the big indexes. And at that point, nibbling seems a little bit more reasonable.
Well, what I liked about Friday was there was really heavy volume in both the futures and the options world. I think, we didn't break any records, but there was really heavy volume across the board, which I like to see, especially on kind of like the first or second down day, because that generally means to me that, we're not done yet. We'll see, but I don't think we're done yet. And I think in general, there was the first time we saw market down, bonds up big. So it was almost like a normal, like the old school normal inverse relationship between bonds and stocks, which was kind of nice to see. Brought back some memories of how things used to be, and
how they should be, right? Economy's bad. Forward returns for stocks are going to be worse. Lock in your bond returns.
Well, there's no question that this administration's been trying to send a message that the economy is strong, and the economy is not strong. And the dollar is not strong. And
I've been dying to know what you think about what happened on Friday with the BLS commissioner, the head statistician, being fired because she didn't give Trump the numbers that he wanted to see.
Well, the lucky thing for you is that is the topic of my cherry bomb tonight. And it's already been submitted, so there's nothing I can do to change it at this point. And it's a little bit of, I take a vicious shot at the current president of the United States, because what happened on Friday was one of the most pathetic things I've ever seen politically in my entire career. So we can talk about it more this week, and I'm sure people will. But this is America. We don't do that. That crap doesn't fly here, or it shouldn't. Let's put it that way.
Sure enough. All right. Well, let's move on then. We have earnings here this week. I mentioned a few of the names. Disney, McDonald's, you said aren't going to move the needle.
I don't think so.
Palantir has been one of these high flying names that's gotten everyone's attention. It's kind of a meme stock in a certain way.
Oh, I think Palantir is one of those fringe stocks. I wouldn't call it a meme stock, but I would say it's a fringe stock that is very closely tied to, it's very closely tied to the current administration, and it's very closely tied to kind of what's happening in it. It's kind of paints. I think that it paints a picture. It's actually a pretty good measure of what's going on in this country, because Palantir, I feel like it trades almost tick for tick with what people are thinking. I know that sounds kind of crazy, but Palantir is one of those stocks. I'm not going to give it to, I don't have very many other stocks like Palantir. And I think it's one of those stocks that's kind of in its own little world. It almost feels to me like it's like a scout, and it's out in front of the market. And it's also another one of these stocks that's fully priced, but it relies so heavily on government contracts, so heavily.
Yeah, it just got a $10 billion contract announced last week.
Of course. That's why the stock was only down $4 on Friday. But, they're throwing money at Palantir. It's almost like something, I don't know. I got a weird feeling about it, but that's all.
I'm curious then, if you think that Palantir is a scout for the market, how does that change your overall view on equities? If we think that perhaps a pullback could be coming here over the next few weeks and various positioning is situated to that effect already, does the lack of a down move in Palantir suggest that the broader equity move could be a little bit more shallow?
No, I just think Palantir has a weird little floor just because of some of the stuff that's going on recently. There seems to be buyers below the market in there, but I also think that you're going to start to see, you saw some of the key players roll over on Friday, and I don't think these stocks come back like literally overnight, but there was a lot of damage done. Across the board. There was basically, other than Costco, I don't even know really of any stocks that really, other than Costco and Reddit, which had earnings on Friday. Reddit was unbelievably strong, but other than Costco and Reddit, I don't really know many stocks that had rallies on Friday. And the market, I didn't think it handled it very well. I didn't think there was any rallies intraday that were interesting at all. And I did not think the market, I think the market's going to try to rally early this week, maybe tomorrow morning and maybe Tuesday morning. And how well those rallies hold up, if they hold up at all, will determine what happens later on in the week.
You mentioned what companies did well on Friday, but the only two that came to mind were Reddit and Wingstop. I guess a lot of people are sitting around eating wings off their bellies like otters while scrolling the internet.
I don't even know what the symbol for Wingstop is. What is it?
Wing. They got a good one. Nice ticker.
Oh, I've never traded Wing. I don't even know. I can't even tell you what's trading for. I'm going to put it on my watch list.
It's a $362 stock now, naturally.
Unbelievable. I've never traded it. But yeah, I did trade pretty much all the earnings trades last week. I would say from an earnings perspective, it was a tough week because there was a couple of outlier moves and there was some, I would say it was not the best week for earnings. I would say the outlier moves, like, for example, in Coinbase, in Microsoft, in Meta, in Reddit, those outlier moves, there was more outlier moves last week than we've had all the other earnings weeks combined. So I don't think last week was really a good week for earnings. Forget about the results, forget about how anything did. I think it was a really tough week. We had more stocks that went outside of their expected range last week than we had the entire last cycle. So last week was a tough one for earnings plays.
Tom, we're going to bring in Ilya in a few minutes, and let's keep the bonds and FX conversation for him. But before we get over there, there's some things to talk about in the commodities, I suppose. The news flow around Russia, Ukraine the past few days has picked up. We've actually seen volatility bump up from in the teens back up into the 30s here during the course of this news flow. It's a 35.4 IVR. I suppose what I'm getting at is the difference between equity index volatility on an IVR basis and crude oil is starting to narrow because equity vol is pumping up. Do you think it's worth taking a look at oil and other commodities right now while you have equity vol on the march higher?
Oil traded really rough last week. It had some huge outlier moves to the upside and then back down to the downside a little bit. So crude oil was not easy. In the 5 days last week, 3 of them were outside the expected move significantly. So oil was a really tough trade in either direction. You could get caught short on the way up and then caught long on the way down. I thought oil was almost an impossible trade last week. I thought gold was a little easier, except it even had some big moves. But crude oil, next to impossible. Bonds, if you were long them, it was an easy week. But if you tried to trade them neutral, another tough week. So I would say that commodities in general, and forget about the US dollar. The US dollar was almost untradeable last week. It was so, directionally, it moved around so much that there was no way to, volatility just exploded everywhere. So I don't think it was an easy week for commodities unless you were trading, the stock indexes and unless you were leaning a little bit short. I think it was easiest to lean short in the US stock indices. And I think everything else, unless you were like leaning long in bonds or doing something else directionally, man, it was a tough one. I thought really tough. And even tough if you were trading stuff like, Bitcoin and something like that. I mean, that had a nice little, $6,000, $7,000 sell off from the top. I don't know that there was an easy commodity last week, and forget about copper too. It's almost untradeable. Natural gas is about to break $3. I mean, there was some challenges last week. And so I can tell you right now that I don't have a short premium position in futures options that had a good week. Not a single one.
Yeah, I'm thinking about myself. I've been trading short iron condors and crude oil consistently since the Israel-Iran war ended. And even last week with Friday's move where it basically gets back to the midpoint of my range, I'm looking at the volatility expansion and I made no money, even though the market net really hasn't moved that much.
No chance last week to make money selling premium in any commodity that I can think of, unless you had direction on it. I don't think there was a single futures option that I can think of where vol came in. It came in the bonds, but on Friday again, bond prices exploded. But vol came in the bonds early in the week, but that's about it. I don't think it came in anywhere else. And I would be, I don't think it was a good week for short premium trades in any of the futures options. In some of the stocks, I think it was okay early in the week, but by Thursday, Friday, it got tough, man. It was hard.
It did get tough. So before we bring in Elliot, one last question here. Dr. Sosnoff, I'm sitting in a short iron condor right now in natural gas. Natural gas continues to just defenestrate me from my past few trades. Do I get out here or do I keep playing this because it's a 42.1 IVR?
Yeah, first of all, the IVR is high. Second of all, you have plenty of time to expiration. Third, it's defined risk. So why would you touch it? The only thing you could possibly do is, depending on how lopsided your iron condor is, you could roll your call side with a spread a little bit lower. So like if you have a big put spread and a tiny call spread now, you can roll your call spread down a little bit and take a bigger credit in. But there's no reason to even consider, IVR is high, plenty of time to go. No reason we would ever take that position off because you don't know what's going to happen. Just lower the call side a little bit.
There you have it. Stay mechanical. Tom, what do you say we bring in Ilya and start talking about the US dollar and bonds here, which we haven't covered yet today?
Yeah, sure.
Ilya, welcome to the Thunderdome.
Gentlemen.
2 men enter, 1 man leave.
There's 3 of us here.
I know. Well, I'm just repeating history. I mean,
Okay. Yeah. All right. Good weekend, Ilya?
Yes, actually. It's a beautiful, sunny weekend here.
Yeah, I had just a great day yesterday. Got some yard work done. We went to the pool for the day. I went to a neighbor's house for a dad's barbecue, steak and beer.
Fantastic.
Then watched a movie last night. And I got to say, these Now You See Me movies, I watched the second one. It wasn't a good one. I hadn't seen it before. It just wasn't good. It wasn't good.
I haven't seen a really like I was just on plane rides to New York there and back. Probably the best movie I watched was the Led Zeppelin documentary.
You know what's
There's just
funny?
not much there.
I just saw that. It's great. I liked it a lot.
It's really good. It's really good. No, you know what? Scratch that. Working Man with Jason Statham was very kind of classic escapist action.
Jason
Done well.
Statham plays the same character in every movie.
Yeah,
but that's why it's great.
But I didn't see that. But I did really enjoy the Led Zeppelin documentary.
It was so well made. I really enjoyed it.
Yeah, I enjoyed it too. Yeah, every Led Zeppelin fan should watch that. All right, Ilya. So, I mean, the big explosion last week was in the bonds, and now they're back to a level at 115.20, where this would be a very accommodating price level for the Fed to actually, I would say here you're pretty much flipping a coin. You're 50-50 with the odds-on favorite that they will lower rates if they can stay over 115 and let's say 115 and a half, 115.20. And if they get over 116, I think it's almost a lock. What do you think here?
Yeah, I mean, I think at this point, you really are reminded again and again and again and again that when the Fed gives you what they think they're going to do, and then the markets do what they think the Fed is going to do, the reaction function at the Fed is slow, and they don't change their mind that much. But the markets are, of course, open every day, and they jump around, and there's a lot more noise. I think the Fed is basically on course to do what they've been saying all year, which is to cut 2 times, probably in the back half of the year. There's no meeting in August, so we'll get one in September, and then we'll get one in October or December. I think the markets now think probably October. But yeah, I think they're going to do exactly what they've said all along, which is to cut by 50 basis points in the back half of this year.
Yeah, I agree with you. And if they have bond step here, which is why I think the bonds are a buy on any dip.
Yeah, I agree.
That's been the easiest, to me, that's been the easiest trade out there. It's just buying the bonds on every dip. That's been the simple trade, hasn't failed once this entire year. And that's been the easiest trade on the board.
When you say buying bonds, is that buying calls, simply long futures, or you mean selling puts?
You can do it however you want. Delta's Delta. Doesn't matter.
Okay.
Sell puts.
Well, and
sell puts.
IV has been so low.
Spreads, buy bonds, whatever it is. It doesn't matter.
Okay.
A delta is a delta. It doesn't make a difference. What matters is what product you use. But it doesn't make any difference how you do it. It's been the easiest trade, I think, on the board, and it's and as long as they, all this Fed chatter and talk just stays on front page type stuff, it's the liquidity's in there. I mean, massive liquidity in the bond options on Thursday and Friday, massive liquidity in the note options, which was nice, ZN and ZBs. And, that's been the easy trade. The hard trade here is going to be the S&Ps. That's going to be
I've been sitting in long positions in the long end for almost a month now, and I still have like 47 days to expiration. So I've been just building tons of duration into everything to sort of feel out the market because it's been so jumpy. It's finally starting to work. There's no reason in my mind to do anything but just sit in the bonds, and when they give you a chance, add, because this looks like it's going to be a run now. Maybe not immediately, maybe not tomorrow or the day after.
You know what?
But
here's the thing, Ilya. You didn't get paid for doing that this entire year. So the hard part for traders is that it's easy to sit back and say, you should just add. But the reality is every time the bonds got up to 115 and a half, where they are now, or 116, if you sold out your longs, you have had 6 chances to reload. And so for the passive longs, it's been a crappy trade all year. For the traders who have bought every dip, it's been a great trade.
Yeah.
It's not that easy. I don't actually like the passive long side here. I like you sell them into the rally, you buy every dip.
I think at this point you're starting to get to a place where you're absolutely right. It's been in a range basically since mid-April after the Michigas. And from here now,
Just use the word Michigas.
I did, and I'm running out of.
Explain that the Yiddish doesn't go good with our
I'm running out of euphemisms to call what that was. And so now I'm looking at it and I think maybe there's a breakout now. Maybe
but
a trend.
who cares? Who cares? It hasn't that having that. Maybe there is, but who cares? It doesn't work so far.
Yeah, that's why I asked if deltas are deltas, Tom, because I'm thinking about like my own struggles in gold over the past few months. Gold's been terrific to me this year, but the past few months, Ilya and I have both been bullish. He's been short puts and I've been long calls, and he's made money consistently since April in gold. and I have not, even though we both have, the delta is delta kind of view. So that's why I'm thinking here. I see something that's at the midpoint of its trading range for this year, both in notes and in bonds. I'm personally leaning directionally neutral. I don't see us getting up to 121 in the next month and a half. And it feels like there's still a little volatility that we can sell up there. So maybe this thing rallies further. But getting up to 121 means like 4 rate cuts before the end of this year.
No,
and that's
the low 120s probably means 2 to 3 rate cuts.
Okay.
Yeah.
Yeah.
Well, and to Tom's point, right? If you're not long bonds from lower levels than here, this would not be the place because you're basically sitting at the top of this range. So either you'll pull back, which I don't think we're going to do, or you'll break out. And that'll basically reset risk reward for you. Either way.
Oh yeah, we held off a conversation here on currencies, but we come into the week where the dollar is gapping open lower right now. Euro's higher, yen's higher, pound's higher, all out of the gate.
This is one of the most exciting things for me now.
Yeah. So the volatility's here though, Tom. I think that's the main point. While we're seeing pockets of volatility in other places, bonds and notes still in the teens, the currencies across the board, euro, yen, not the yen, but the Canadian dollar, the pound, the Aussie, you're getting a little bit more than that here.
Yeah.
What's your take after Friday's big reversal in the dollar? Is the dollar bottom finished?
I mean, you got more. There's actually another huge up move tonight. I think the dollar had its dead cat bounce. I mean, I don't know how else you could look at it. The dollar had a really nice bounce, almost, whatever, 3,000, basically 3,000 points and, or 3,000 bips. And, now we just had almost 2,000 points to sell off again, or just under 1,800. The dollar's weak. The dollar's weak, and the question is, when will the U.S. stock market pay for the weak dollar? Like, I understand that the weak dollar has supported the stock market, but the whole narrative that U.S. stock market has been strong, so the economy has to be strong, I don't think that flies with me. I think what's happened is the U.S. economy is weak, but people think they're buying stocks. People outside the U.S. not using U.S. dollars think they're buying stocks at a 15% discount from where it was earlier this year. So I think they think things are cheap, and then that's a good place to listen. You'd rather buy dollars where they are today than dollars where they were buying them 6 months ago. So
Absolutely.
I think that's been supporting the market. And I think that, when you go back and you look at different times in history, when the dollars acted this weak, this poorly, I mean, you can go back and a lot of people blame the crash of 87 on the weakness in the dollar. Let's not forget, the
Plaza Accord, yeah.
Super weakness in dollar has led to some really unsettling moments in the market. And I don't think that you don't hear enough chatter about, you know what? I mean, for people that think, oh my God, the market's just off all-time highs. Well, it's just off all-time highs, but the buying power of the US dollar is down by literally 15%.
Absolutely. I mean, that's one of the things that in my mind, I mean, obviously Chris and I harp on it endlessly, but you don't hear it in the wider narrative that actually the stock market rose much less than the dollar fell in the first half of the year, almost double. So look across indexes, you got maybe somewhere between 5 and 7% on each one of the majors in the first 6 months of the year. Once all the tariff back and forth was figured out, at least in that version of it, sort of April onward. And the dollar was down almost 14%. So if you were long in anything but US dollar terms, you lost money.
Yeah, it hasn't been the easiest year for investors, and I think we're forgetting that too. I saw a really interesting report from Deutsche Bank over the weekend. Ellie, I'm going to forward it to you.
Yes.
That even though the dollar's down because of the differences in inflation, the Chinese yuan's real effective exchange rate is actually weaker than the dollar's has been throughout 2025. So
that wouldn't surprise me.
You see all this dollar weakness, it's going to help bring back manufacturing. How did the PMI data this week shows that manufacturing is not
absolutely not
coming back here in the United States over the last few months as a result of the tariffs. So more fun in the barrel here. Tom, we have 2 minutes left. What would you like to talk about as we go into the close? Because it seems like we've ticked every box. It's a light open. S&Ps are off by 0.1, NASDAQ 0.13. Earnings this week aren't that heavy. The macro calendar is not that significant after we finish acronym week. What's the number one thing traders should be worried about in the days ahead?
Well, what they should be worried about is that we had a pretty ugly close to last week. You know, we had kind of the first, I mean, you can go back for essentially, you know, you'd have to go back to April. So you got April, May, June, July. You have 4 months where since the beginning of April, we really haven't had a downtick. And we haven't had like any kind of a sustained move outside of like, you know, 2 or 3 crappy down days. We finally had a little bit of a sell-off towards the end of last week, but I don't count that yet for anything. But I think that it does raise at least a little bit of, you have to think about it a little more cautiously now, because for the first time, you had a pretty much across the board selling, and you had a little bit of across the board nastiness. And I don't think we've been able to find sellers in this market for almost 4 months. Like we can't, wherever you look, you can look under any rock. There's no sellers anywhere. Everybody has been so comfortably long. And I think for the first time, sellers came out of the woodwork, especially on Friday. And I think, you know, a lot of what's held this market up is, you know, the idea that maybe all the earnings will be good, you know, maybe that things are going to, you know, interest rates are going to start to go down. I mean, it's just a lot of different things, you know, like some of the political turmoil can't be any worse. It's got to get better. And I think last week was maybe a little reminder that maybe the risk of this market being overpriced is a little greater than people were actually pricing into the market. And maybe it is a little frothy. And let's see how shaky it is here. Let's see how thin it trades this week. I mean, are we going to have some up days this week? No freaking question about it. You know, are we going to be up big tomorrow morning? We could be. We didn't close underwater on Friday, that's for sure. So we're not like starting with you know, we're not starting at really cheap price or anything like that. But there was some damage done on Friday. Anytime you get stocks, we talked about it, like Amazon down 20 and, you know, Roku down 15, and you're starting to get a lot of these things, you know, Coinbase down 63 and Apple on good earnings down 5. Now, you don't get a lot of Apple earnings turnaround intraday. When you start to see that stuff, you're like, oh man, maybe there are sellers out there, and at least be aware of it. I don't think you have to trade that way, but be aware of it.
Yeah. I mean, I think the interplay between assets this week is going to be really interesting. Obviously, the dollar got smoked as stocks fell on Friday. I actually think that's probably a dynamic that's going to go away. And we're going to get much more, especially if stocks keep going down, we're going to start to get into a sort of risk aversion classic. And if you look at what that is, that's bonds up, dollar up, stocks down. And if you look at where the dollar stopped as it was selling off on Friday, it just pulled back to the underside of the range, but then it held. And it did not cross any Rubicons back into that kind of area where it started to form this bottom. So in my mind, one of the more interesting things here will be, especially if stocks start to break out, is if the dollar rallies as they sink, because then we could be in a whole other type of correlation one environment.
Tom, I got something for you here as we close this out. For only the third time in history, tech stocks now are 2 standard deviations above their long-term valuation relative to the S&P 500. The other 2 times come in the early 1970s, and of course, the dot-com bubble. And we've seen research that shows the AI bubble is now bigger than the dot-com bubble. So, fun week ahead for stocks, Mr. Sosnoff. We'll be here live all week, though. What time does programming start tomorrow?
I just have one comment on this.
Sure.
It's going to be really interesting a couple of years from now to look back and see if they call this the AI bubble. There was no doubt in my mind in 2000 that we were going to call this the dot-com bubble. I mean, it was so obvious. Like it was unsustainable at any level. This is different to me. And this doesn't feel like it's the same kind of a bubble. Like that felt it was completely unsustainable in 2000. And we were just waiting for the market to roll over and crash. It took about 6 months longer. In 2009, the down move at that point seemed unsustainable because it got beyond ridiculous, unless the whole country was going bankrupt. So there are different times in history we go back and look at the markets, we think, oh, you know what? This kind of makes sense. But right now, I wouldn't say that I have that same feeling that the AI bubble is, I wouldn't say that it's a bubble. I'd say it's frothy. And I'm not sure that we're going to look back. I'm curious how we're going to look back at this 5 years from now. And we're going to go, was this a layup? Did we all just freaking miss a layup? Was this like completely obvious that Palantir should have been sold at 160 and Nvidia had no right to, we didn't need to have Microsoft as a $4 trillion company, Nvidia as a $4 trillion company. Are there any other $4 trillion companies? I'm not sure. But the idea of a $4 trillion company is just unbelievable. And the question is, are we going to look back at that and say, I can't believe that there was 2, 3, 4, 5, $4 trillion companies? Or are we going to look back and go, I can't believe those companies used to be 4 trillion, now they're 6 trillion?
I think it's both. Because if you look at every single time that you have one of these transformative technologies, there's the hype cycle, and then it turns out it overshot. But then that doesn't change the fact that the long-term adoption becomes then after that the inevitable thing that it was always going to be. And I mean, railroads, telecoms, whatever. So
I don't disagree with that at all, by the way.
Yeah. So I think it might be a bubble, but that's not going to change the fact that AI it's a speculative valuation bubble. The technology itself is obviously not a bubble.
No, we're not going back into the cave on this. It's here. Yeah. It's here to stay.
I mean, if you want to think, Chris, about last week, I would think the thing that was most scary about last week is that you had like a $33 IPO that essentially trades up $100 2 days later.
Figma.
Yeah, I know. But you're talking about like to me, that's bubblish. Like there's no other way to explain that. That's bubblish.
You can't.
That seems to me like greedy. That's greedy. This has been happening a lot more recently, and maybe we should talk about this week on Let Me Explain or a Truth or Skepticism, right? Yeah. I've seen this a lot, and I got to get the data to back this up. It feels like companies are being mispriced intentionally so that the insiders are able to just sell out. You're getting these big multiples out of the gate on some of the IPOs where it's like, why were they listed at $35 a share when it's closing at $110?
Well, the insiders usually can't sell. So it's
not the company insiders. I mean, like the people at the Morgan Stanleys, the Goldman Sachs of the world who are going to sell shares to their clients.
So none of those people can sell. The only people that can sell are the people that they actually give the stock to.
Right.
So, like their best customers.
So they're giving their customers at 35 when they know it could IPO for 100.
Right. They're just rewarding their best customers. That's my point. You're not rewarding the company. You're not rewarding the company employees. No. You're not rewarding the people that bought the stock early because it's restricted for 6 months. So you're just rewarding the people that can sell it on the first day on the jump, which is your own best customers, which is absolutely bullshit in my opinion. But it's also who's buying this stuff up $100. Like who's buying?
Tom, what? Not me. Not me. Tom, we're running a little bit over here. What time do we start tomorrow morning?
In London, 1:30 a.m. Central Time, or 2:30 your time on the East Coast. But in Chicago, 7 a.m. tomorrow morning.
Excellent, sir. Thank you again. Good to see you. Ilya, good to see you as well. Everyone, thanks for watching First Call. Go have a nice night. See you bright and early.
Ciao for now.
Amazon earnings are out. Apple's up next. It is Thursday, July 31st, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak's in San Francisco. No Radigan today. He'll be back with us on Monday. But we're here for now to take you through the futures market close at 5 Eastern, 4 Central. If you're on the platform Tasty Live, nope, that's the website, tastylive.com. The website's Tasty Trade. Either way, welcome to the show. Come over to YouTube. Tell us what you're trading, what you think of this action. As Sunagoon said, was my bouncy, boyish joyousness yesterday the sign of the top? Maybe indeed. The NASDAQ did rally up here today, only for a little while before it came crashing back in. We have a Microsoft and Meta earnings jubilation overnight, adding more market cap than, say, the entirety of a Costco or Netflix, as we see, is eradicated, and then some today, where we do ultimately get a move and close below yesterday's low. Ooh, so spooky. An engulfing bar. Key reversal at the end of July, heading into the seasonally most bullish time of the year for volatility. Ilya, Microsoft and Meta did make a ton of money, but the market today decides to take some profits. We see a NASDAQ surge to new all-time highs and close below yesterday's low, which is among the worst things that could happen. If you are a bull and have been riding this Icarus into the sun, the wings have, technically speaking, perhaps melted off at this point in time. But we do have Amazon out here after hours. And before, Ilya, we go into this price action for today, I do want to go to the chart. Those earnings are better than expected across the board, which is what makes this reaction, Ilya, as you pointed out, all the more interesting. They beat on EPS, $1.68 versus $1.33 expected. That's a 33% beat. Their revenue is $167.7 billion versus $162 billion expected. Another fantastic beat. The guidance for Q3, the high end was $173 billion. They've guided for $174 to $179 billion. And AWS, which contains their AI efforts, $30.9 billion, 17.5% growth. Ilya, even Amazon here with its strong earnings in the mirror and reasonable growth expectations moving forward, the market is not running with this either, despite bidding it higher all day. We await Apple in a few moments' time, not just yet. But as a bear's bear, as someone tweeted at me today, you were probably feeling really good.
As we were talking about those spikes on the Meta earnings and the Microsoft earnings exactly 24 hours ago now on yesterday's show, my concern with that exuberance was that what happened earlier in the day was the market's displeasure with the Fed, and the exuberance was coming on the back of catalysts that were perhaps short-lived. Those earnings were undeniably impressive, and we didn't learn in them anything that the markets hadn't known. What we learned was perhaps that the forecasts were woefully inadequate, but that was just about it. And what I was concerned about was that the story with the Fed was a bigger story, and that we had to be careful before we over-extrapolated a move in absent liquidity before the Asia Open even got underway. And indeed, things held up. They held up in Asia, they held up in Europe for the most part. And then when the US market came in, the price action told you very clearly what they thought. And the whole thing caved in on itself. So this was exactly the thing that I wouldn't say I knew that it was going to happen. Of course I didn't. Nobody could. I was concerned that it might. Because the price action around the Fed and the remaining event risk for the week really did look potent. And of course, the event risk is relevant. So what the markets are telling us here, seemingly, is that good news is unable to impress. And that is more bearish than if the markets were falling on bad news. And that should be a point of concern for risk sentiment all around.
Amazon here, 228 now, right after hours. That action today in the NASDAQ, very brutal. You were asking me how hopefully I got out of my stuff. Partially, over the course of the day, as I was talking with Nick, it's funny, I sent Nick a message this morning at 10:12 a.m. Eastern time, and I said, this thing is either going to close at all-time highs or we're going to close red today. And that seemed nuts at the time. But the read I was getting on the tape was that you were seeing the Russell fail in certain areas. We can go over to that 15-minute chart just to show.
That thing has been heavy as a rock, obviously, despite the tech earnings where it really couldn't benefit.
10:15 this morning is basically 2240 in the Russell. Why there? Why at that point in time? I would go down to the daily chart, the 4-hour time frame here. And this morning we had broken out of a flag and we were trying to get back into it. So if the Russell of all things could get back into its flag, then surely the NASDAQ and the S&P would be okay. That obviously wasn't the case. So we have a turn lower here, which now potentially we do need to consider, as Tom was suggesting, are the bears in control now? Is this a potential marking for a top? We do have tariffs going into play tomorrow, Ilya.
Maybe, yeah.
Do have non-farm payrolls potentially coming out tomorrow morning. Well, they're definitely coming out tomorrow morning, but that is potentially something that could be a catalyst in this market as well. We're still digesting the Fed. Are we for the stock market at least, are we still in a good news is good news world, or is good news bad news now because the Fed won't have an excuse to cut rates? I'm trying to figure out what the thematic narrative is on that lens after this week. I think we're going to have to think about it for a few more days once we see an FP.
Yeah. I mean, in my mind, it's kind of neither. It's middling data is the worst for risk sentiment. Because I think the markets very clearly are telling you that they want these rate cuts. There's just no question. The markets are also seeing that those rate cuts aren't going to happen near term. I mean, just look at what the pricing is for Fed funds futures for next year. We're out to 83 basis points. The markets see at least 3 cuts, and they're inching closer to 4. What we see from the Fed, obviously, is only a single rate cut that they've forecasted in June. Obviously, take that with a grain of salt. They're probably half-hearted on the 50 basis points that they projected then for this year, if you hear them yesterday. And the market's obviously now hearing that loud and clear. You can see it in the dollar, certainly, where the markets only have 1 cut maybe for the remainder of this year. We're out to 29 basis points. That's making now September look unlikely by about a 40-60 spread. 60% chance rates actually don't come down in September.
That was perhaps one of the shocking developments of today's market. Post PCE, we have a market that's saying the odds of a September cut are less likely.
That's right. Well, and with that, the worst thing that seems to stand here in the way of markets is jobs data that's weak enough to